So we were doing the chapter uh, corporate valuation, which is equity valuation. We did quite a few concepts, that is earning capitalization, dividend valuation, multiple valuation multiples like EV to EBITDA, P multiples, sales to price ratio, like that. Now let us talk about one important aspect is in the value method only, valuation using FCF. Valuation using FCF. FCF stands for free cash flow. People also call it as DCF method in practical life. DCF method. Discounted cash flow method. DCF method. So what is this valuation using free cash flow? The same concept what you discussed in dividends, we are going to apply here. But dividend was from the point of view of shareholder, what he receives. Dividend what he receives. But you'll also have something is undistributed reserves, right? Like retained earnings. So rather than thinking from a dividend perspective, why don't you think from the whole entity perspective? And that's what is free cash flow method. So basic meaning of free cash flow method means meaning of free cash flow. Cash flow available after all obligations. Cash flow available after all capital expenditure and obligations. After all capital expenditure and obligations. Please write it parallelly along with me. Cash flow available after all capital expenditure and obligations. So we are focusing on cash flow, my dear friends, not on profits. So if they are given profit after tax, we have to adjust. What is the first thing that comes to your mind when you have to uh, convert from profit after tax into cash flow? What is the first thing that comes to your mind? Depreciation. Exactly. So from the profit after tax, when we talk about, we have to calculate depreciation. We have to adjust depreciation and other things like capital expenditure. Do you remember in cash flow statement, we have three kinds of activities: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Now, in cash flow from operating activities only, we start with profit after tax and we add depreciation. There is one more important, a group of adjustments will come. Do you remember in cash flow from operating activities, from profit after tax to reach cash flow from operating activities, we take depreciation, but we also take one more important adjustment, one more group, I would say, one more set, I would say. Any idea? Remember what is that important set of adjustments that we do? It is working capital adjustment, right? Increase in working capital, right? Adjustment for working capital, like increase in debtors, decrease in stock, things like that, increase in creditors. Hope you remember it. So after considering all those things, what cash flow you get, that is free cash flow. Formula will come to it. I hope you're trying to get the feel of it, what I'm trying to tell. Why I'm calling it as free cash flow? Because, not because available free. Free cash flow means after all obligations. Let's think about a salary man. You get 1 lakh salary. Out of 1 lakh salary, you spend for households. Let's say whatever, this much, that much you spend. Then you keep aside for EMI, you repay. Then you keep some savings because you're planning to buy some car. So you invest that, or you transfer to some SIP, systematic investment plan, keep the money in mutual funds. So after all everything, you purchase some furniture. Let's say you purchase some new sound system. What cash flow is available on your hand? That is what is free cash flow. So free cash flow means available to the entity without any restrictions. No repayment obligations, no future investment thing. Everything we have set aside, purely what is cash flow available. Typically, practically, initially for companies, free cash flow might be zero or very, very less. You know why? Because initially you have to purchase lot of things. Furniture you have to purchase, building you have to purchase, machinery you have to purchase, softwares you have to buy, Amazon subscription. I mean, Amazon means for AWS. I mean, online, because cloud software you have to purchase, Google Drive. Space you have to purchase, maybe website hosting to be done. So lot of cost will be there initially. So free cash flow will be less. Only after a particular point in time you will get free cash flow. Formula I'll compare. I hope you got the overall view of it. What is free cash flow? Okay, then let's tell you the valuation, or let's say types of free cash flow. Types of free cash flow. Okay. One is called as FCFF, free cash flow to firm, and the other is called as FCFE, free cash flow to equity. FCFF, free cash flow to firm, free cash flow to equity. I think heading I would have given only free cash flow. I'm yet to come to the valuation piece. Anyway, no problem. Uh, so meaning of free cash flow done, types of free cash flow done, types of free cash flow to firm, free cash flow to equity. First of all, I hope you know the meaning of firm or meaning of equity. Firm means from the business point of view. Equity means from the owner point of view. That is, firm means from business point of view. From business point of view. And equity means from owner point of view. From owner point of view. I hope you're writing parallelly with me, because otherwise you may not be able to understand my great handwriting. So if you write along with me, as and when I speak, you'll be able to hear and write it. So from firm point of view and from owner point of view. This is one separate distinction you have to understand very clearly. What is written in the brackets on the top? DCF method, discounted cash flow method. In examination, we don't use that name, but practically people use that name, DCF method, discounted cash flow method. Because we will be using cash flow and we are doing present value of it. So popularly people call it as DCF method. But in exam, we just call it as valuation using FCF, FCFF or FCF, free cash flow to firm or free cash flow to equity. So FCFF, from the point of view of business, whereas FCFE, free cash flow to equity, from the point of view of owner, from owner point of view. I'll have to explain now. Hope you've written till here. Done? Okay. Okay. Now, let me give one small example. I am giving the same example. I will continue the same example. Let's say you take an example of house property. House. House value you have purchased for, let's say, 50 lakhs. And you have taken a loan, or let's say, I'll say 8% loan of 20 lakhs. Let's say how the balance sheet will look like. Okay, somebody wants the previous slide. I'll show it to you. Please write it down. Then I'll go forward. Okay, very good. So if I prepare one balance sheet for this, how do I prepare? Simple balance sheets. I will say asset value, house property, or building, whatever you can say. You say 50 lakh, right? You write 50 lakh here. On the liability side, you write debt, 8% debt, 20 lakh. And what will happen to the balance? What do you call? How did you get the balance money? 50 lakh minus 20 lakh. 30 lakh comes from out of your own resources. Out of your own resources means that is equity, right? That is own funds, internal funds, shareholders funds, net worth. Whatever you call it, all are same. That is 30 lakh. In simple words, I will say equity. Equity. This is balance sheet point of view. So when I say 50 lakh, that's what I mean by value of firm. So when I say 50 lakh, I say value of firm. This is book value, of course. Present value will be different. And when I combine these two, that's what I get value of the firm. Both are same. Equity plus debt, or value of business, value of entity. That is value of firm. Equity plus debt, you can say. But what is 30 lakhs alone? And that is called as value of equity. Again, these are all elementary levels. I mean, this you should know in the intermediate level. You have a chapter of capital structure theories. You would have learned value of firm, value of equity, net income approach, net operating income approach. Anyway, so if you remember, you can recollect. But I'm trying to tell you very basics. Hope you don't have to worry about anything in the past. Okay, so value of equity means the 30 lakh equity. Directly you can take share capital plus resources surplus, that is equity, or you can also calculate asset minus debt, that is 50 lakh minus 30 lakh, also will give you same number, right? 20 lakh. So equity value you can compute directly, or you can also do value of the firm minus debt, also will give you value of equity. Value of the firm is 50 lakh in this example. Debt is 20 lakh. 50 lakh minus 20 lakh, 30 lakh. And that is value of equity. Please write down till here and let me know if I have to, 50 lakh minus 20 lakh. 20 lakh is loan. So 30 lakh is value of equity. So 30 lakh, directly you can say value of equity, or value of the firm you can take, that is house property value, value of the firm, minus debt also will give you value of equity. Don't worry about the formulas. I'll give you in a separate slide. First, try to get the concept right. Write it till here. Any doubts? Let me know. So value of firm is the value of house property is the value of business. If I subtract that, I get equity. Some people call this value of the firm as enterprise value also. We are discussing earlier. That's simply called value of firm. Is it completed? Is it fine? Shall I go further? Yes? Okay, thank you. So now I'll try to talk about the income statement. I'll try to talk about the income statement. Now you please tell me, from the house property, rental income you get, let's say, 5 lakh per annum. It may be much less, let's say 5 lakh per annum. And interest expense is how much? 20 lakh into 8%, 1,60,000. So you get net profit. Assume no tax. Assume no tax. So net profit, what you get is 3,40,000. Okay. Income statement, or assume no depreciation. So this will become cash flow also for our discussion purpose. Of course, we'll have to adjust many things for the time being. Assume this is cash flow also. Important point. Listen to me carefully. Simple point. But somehow many people get confused here. They keep asking me this doubt. Listen to me and try to answer it. From the house property point of view, which profit is relevant? 5 lakh is relevant or 3,40,000 is relevant? From the point of view of the house property, if somebody wants to purchase house property, will they look at 5 lakh in mind or will they look at 3,40,000 in mind? 5 lakh. I hope everybody is absolutely clear about it. No confusion, right? I'm happy everybody is giving the right answer. Absolutely right. No confusion. But why do you get confused in solving problems? Which means when you think from the firm point of view, the relevant is profit before interest or cash flow without considering interest. Whereas from the equity point of view, from the owner point of view, owner has taken loan. So owner interest has to be paid. For the owner, net income from house property maybe you have to subtract interest. But from the property point of view, from the business point of view, from the firm point of view, interest, income should not come. So when we are valuing the firm, the profit what we take is before considering interest. Okay, so okay, there's nothing to write here. Let's come back. So from business point of view, what relevant profit you are calculating? Relevant profit. Relevant profit from business point of view is going to be EBIT, earnings before interest and tax. I should not consider interest. And I subtract tax. Means what? 1 minus t, I'll multiply EBIT into 1 minus t. So without considering interest element, I just multiplied by after tax 1 minus t. Basically, what is my net profit assuming there is no interest, and that is called as net operating profit after tax. Net operating profit after tax, EBIT, into 1 minus t is NOPAT, net operating profit after tax. Owner point of view, relevant profit is straightforward, very simple, profit after tax. Profit after tax. What is this point basically means? Interest is not considered in FCFF. Interest should be ignored. Interest should be not subtracted, whatever you can say. We only take EBIT into 1 minus t, we get NOPAT, net operating profit after tax. Whereas for FCFE, equity point of view, straight away we get PAT. Okay, we have to write a formula now. How do you calculate FCFF? How do you calculate FCFE? I'll go to the next slide. I hope you are clear till here. Relevant cash flow, I'll write in the next slide. You can write, if you have space below, you can write it, or you can also write it separately. Relevant cash flow, I'll write cash flow computation, I'll write separately. So, hope I'll go to next slide. Relevant cash flow, I'll write it now. Okay, so relevant cash flow. So, let me write first relevant cash flow computation. How do I calculate for FCFF? How do I calculate for FCFE? Okay, now for FCFF, what will be our starting point? Our starting point will be net operating profit after tax. I just told you now, right? Net operating profit after tax. I just told you. We will not consider interest. Plus depreciation, we must do it because depreciation is non-cash. So I will do plus depreciation. Plus depreciation. Then what else will come as an obligations? Plus minus capital expenditure. Minus capital expenditure. Popularly we call it as capex. Capital expenditure, capex. Minus increase in working capital. Increase in WC, working capital, not World Cup. So we start with NOPAT, net operating profit after tax. We add depreciation because non-cash. Capital expenditure, we have to purchase furnitures, machinery. So our cash flow will reduce, subtract. And I'll have to subtract increase in working capital. Last is increase in WC, working capital. Why working capital? When the business grows, we will having more debtors, more stock need to be purchased, and more stock means we need to have more capital, working capital. So our whatever money we are generating will go towards future growth prospects, increase in working capital. Okay, now tell me, going back to the same basics, this one, when I calculate cash flow, I mean, when I have loan, I will have repayments also. Now you please tell me, will this repayment has any impact on rental income parts? Will your rental income be affected because you have to pay repayment? That is, if you're thinking, I want to purchase that house, does it matter? The value of the property depends on loan repayment you do. I mean, you might consider have to repay and all, but value of the property is no way affected. Rental income is no way affected by repayments, because repayments is from owner's point of view. Rental income is from asset point of view, firm point of view. I hope these 2 points are very clear in your minds. From the asset point of view, from the owner point of view. Asset and the owner are not same. Typical differentiating factor is loan and interest. So this repayments will not have any impact on free cash flow to firm, but will have an impact on owner, will have an impact on equity. How it will have an impact? I'll show it to you. Okay. You can also write like this. Some people also write like this. No pacts minus, they write like this, minus capital expenditure plus increase minus depreciation plus increase in working capital. Some people also write the amounts like this. Nothing but mathematics minus I'm taking common. When I take minus common, I get capital expenditure as it is. Depreciation plus is there. Because I take minus common, it becomes minus. Increase in working capital minus, I take minus common. So what remains is plus. A minus have been taken in brackets. Why you have to explain like this? Because sometimes in the exam problem, they'll give you net capex, capital expenditure minus depreciation. They'll give you the net amount. So for that purpose, you just keep this also in mind. Free cash flow to firm. This is called as net capex. Net capex. Net capex. Net capital expenditure. Net capex. Okay. Now FCFE, we have to consider from owner point of view. Owner point of view means after subtracting interest. So I will say PAT. Understand the difference. For FCFF, we started with no PAT. Interest was not subtracted. PAT, interest should be considered. That is from owner's point of view. That is, owner of the house property will have the impact of interest expense for his net profit, for his net cash flow. So plus depreciation minus capital expenditure minus increase in working capital okay. Now you write it. One more adjustment you have to do. So I'll explain that. I'll come back to this. Don't worry. I'll give time to write. Let's come back to the same example once more. House property. Now here you think and tell me, you have purchased the property with 50 lakh. Loan you have taken 20 lakh. So your own money is 30 lakh. In this case, can you tell me what is debt to equity ratio? In this situation, if we have to compute the ratio, debt to equity ratio, what would be the number? House property 50 lakh, debt 20 lakh, equity 30 lakh. So what is debt to equity ratio will be in this case? 2:3, right? Simple. 2:3, debt to equity. Okay. Now let's say you are going for house property improvement. You are spending additional 10 lakhs. Or let's say you're spending additional 1 lakh for simplicity's sake. You are spending additional 1 lakh. And maintaining, you will be maintaining same debt equity ratio. 1 lakh, you will be maintaining same equity ratio, same debt equity ratio. So in that case, how much will be coming from loan? Because if you spend entire 1 lakh from your pocket, then equity value will increase. When equity 30 becomes 31, 3:2 ratio will not be maintained. So what you should do then? Entire money you should not bring from your pocket. You have to bring in some sort of loan to maintain same ratio. So how much you have to maintain? If you have to bring in, then 2:3 should be maintained, means this 1 lakh, what do you spend has to come in 2:3 ratio. It has to come in 2:3 ratio. That means, can I say 40,000 and 60,000? That is 40,000, 1 lakh into 2 by 3, and 1 lakh into 3 by 2 by 5 and 3 by 5. So 60,000 is debt, 40,000 is debt, 60,000 is equity. So how much goes from your own pockets? From equity shareholders point of view, how much goes from your own pocket is 60,000. So out of whatever money you are going to take, you have to give up from your pocket, from owner's point of view, only equity portion, equity ratio. Out of 2:3, only 3 by 5, 3 by 2 plus 3. That's what goes from equity shareholders pocket, because rest I take loan. So how can I write this? So PAT plus depreciation minus capital expenditure minus increase in working capital, I will say, plus loan taken. Plus loan taken. Minus loan repayments. Minus loan repayments. Sir, where is equity ratio coming in? Indirectly it is coming in. How it is indirectly coming in? In this example, what is capital expenditure? Capital expenditure you're spending is 1 lakh. And how much loan you're taking? Loan you're taking 40,000. So if I do minus 1 lakh, minus capital expenditure, plus loan taken, plus 40,000, minus 1 lakh plus 40,000. Effectively, that means that is what is going out from your own pocket. Minus 1 lakh capital expenditure. 40,000 loan you're taking. Simply 1 lakh going out. 40,000 coming in the form of loan. Effectively 60,000 is going out from my pocket. That's what I told you. 1 lakh into for 60 by 100. I mean 1 lakh into 3 by 5. That is 3:2, 2:3 ratio we have taken. 2 was debt, 3 was equity. So I've done 3 by 5. 1 lakh into 3 by 5. I get 40,000. That is same as minus 1 lakh plus 60,000. Effectively same number. Loan taken. Loan is 40,000. 1 lakh and 40,000. Effectively 60,000. 1 lakh into 3 by 5. Also 60,000. Are you getting, my dear friends? Minus capital expenditure plus loan taken is same as on capital expenditure taking it proportionately. Loan repayment also, because as a house owner I have to pay EMI, I have to pay some loan repayment. That will also go out from my free cash flow. Rental income, only principal, or because interest anyway I subtracted. Only principal repayment, okay? Don't subtract interest. When I say loan prepayment, it has to be only principal. Because interest I already subtracted in PAT. When I took PAT, interest was subtracted, but principal portion I repay, that goes from out of my pocket from owner point of view. So principal portion to be subtracted in loan repayment. But that is very rare. Very rare it comes. In a problem it might come. I'll just show it to you. Anyway, hope you got this point. Okay, one more formula is there. Sometimes people write like that also. So PAT, I'll take minus common. You know what will happen when I take minus common? It will be capital expenditure, minus becomes plus. So capital expenditure minus depreciation, plus depreciation becomes minus depreciation. That you know. I showed you already what will happen. Same calculation. Plus increase in working capital. Increase in working capital. This whole portion I'll multiply it by equity plus debts. What is equity by equity plus debt? 2:3 ratio. 3 was equity, right? So 3 by 2 plus 3. 3 by 5. 1 lakh into 3 by 5. I get 60,000. Same thing. Equity by equity plus debt. Then close the brackets. Then if you have any loan repayment, you do it separately. Loan repayment. This portion, this equity by equity plus debt, is also called as equity ratio. Equity ratio. If they tell you equity ratio directly, then you directly take. They tell you equity ratio 40%, 40 by 100. Equity ratio 20%, 20 by 100. Sometimes in the exam, the ratio word is missing. They'll tell you equity ratio 30. Percentage they will not tell. Understood, implied. Equity ratio means percentage. And be very careful. Debt equity ratio is different from debt ratio. We discussed in the basics. Debt equity ratio means debt for every equity. Debt ratio means debt divided by total. But we need the equity ratio. So if they tell you debt ratio is 30%, equity ratio will be 70%. If they tell you debt equity is 2:3, then equity ratio will be 3 by 5. Second number is equity. So 3 by 5. Hope you have written till here. Any doubts? Very important, free cash flow computation. Again, I repeat, in NOPAT, interest should not be subtracted. I told you, but I still want more. Interest should not be subtracted. In FCFF, shouldn't be subtracted. In other words, the capital structure should not influence FCFF. Whether you take more debt or less debt, you pay interest, you don't pay interest, FCFF remains same. Because FCFF is irrespective of capital structure. This is free cash flow available to firm, and FCFE, free cash flow available to equity shareholders. Just one question, you tell me, should I subtract dividend from FCFE or FCFF? What do you think? If company pays dividend, should I subtract it? This has no way come in CA examination question, but conceptually I'm speaking. Interesting concept. That's why. When you pay dividend, should it be subtracted from FCFF and FCFE? Or it should not be subtracted? What do you think? Answer is, it should not be subtracted. Why? Dividend, as I told you earlier, is like a withdrawal, right? You're drawing some money. Like in the same example, house property value, what is available to owner is 3,40,000. From his bank, he withdraw 40,000. But free cash flow will still remain 3,40,000. Only 40,000 is what you're paying as dividends to yourself. So what is available to you? Remember, FCFF or FCFE is always free cash flow available. That point you have to keep it in mind. Free cash flow available to firm. Free cash flow available to equity shareholders. So dividend is an appropriation, should not be subtracted. That is one of the reason why interest is not subtracted from FCFE, because this free cash flow is available to the value of the firm. From that, interest should not be subtracted, because for the firm, interest will become then appropriation. So dividend or any appropriation should not be subtracted. Shouldn't be subtracted. Because FCFF, FCFE is amount available, not the net amount. Amount available to owners, amount available to firm. So dividend should not be subtracted. because dividend is an appropriation. In a way, from the firm point of view, interest is also appropriation. Firm has got equity and debt. What is paid to debt, equity is called as dividend. What is paid to debt is called as interest. So I don't consider dividend, I don't consider interest. So from the firm point of view, in a way, interest is like an appropriation. That's why that should not be subtracted. And dividend, anyway, should not be subtracted. Okay, hope you have taken till here. Any questions? Okay, I'll go further. Next, let's come to ultimately valuation part. Valuation part of it. Okay, let's say valuation of firm. Valuation of firm or value of firm. Let's say value of firm. Present value. When I say value of firm, it is present value. That is calculated as, if it is perpetual growth, then what do? FCFF 0 into 1 plus G divided by KE minus G. It's not KE, KO. FCFF 0, that is today year 0 into 1 plus G divided by K minus G. This is perpetual growth. And what is KO? KO is overall cost of capital. Or sometimes we also call it as WACC, weighted average cost of capital. Again, this is your elementary level, previous level. Still, I'll tell you how do you calculate WACC. Overall cost of capital is calculated by WACC is calculated by, I'll just show you the calculation. Cost of equity into equity ratio. Equity ratio will be equity by equity plus debt plus cost of debt into debt by equity plus debt. Basically, cost of equity multiplied by its weight, cost of debt multiplied by its weight. Equity by equity plus debt, that gives you its weight. Debt by equity plus debt gives you the debt ratio, debt weight. And KE is cost of equity, KD is cost of debt, KO overall cost of capital, also called as WACC, weighted average cost of capital. KE, you can do it using CAPM model. We'll discuss CAPM model in detail in portfolio management. And the CAPM formula is what? RF plus RM minus RF multiplied by beta. RF, risk-free rate, plus RM minus RF, market rate minus risk-free rate into beta. Beta. Cost of debt is rate of interest after tax. So cost of debt is rate of interest after tax. So into 1 minus T. Into 1 minus T. Okay. Then this is perpetual growth. If the constant growth happen after a particular time, then what we have to calculate, remember? Like for example, growth happens for first 3 years separately. After 4th year, growth become constant. Then what we should do, remember what we have to calculate? When a growth rate become constant, we have discussed in multi-stage dividend discount model. Like if I use a fourth year cash flow, what I will get? The value at the end of third year. What is it called as a terminal value, P3. Yeah, now we will not call it as P3, we'll call it as terminal value 3, TV3. So in that case, we are going to calculate value of the firm as FCFF1, first year cash flow, divided by 1 plus G, second year cash flow FCFF2 divided by 1 plus KO, sorry, overall cost of capital, divided by 1 plus KO whole square plus FCFF3. I'm writing in a equation format, but while solving problems, we do in a tabular format. FCFF3 divided by 1 plus KO whole cube, nothing but discounting factor 1, discounting factor 2, discounting factor 3, plus fourth year onwards means we get TV3, and that should be brought down. Okay, let me write the formula for TV3 also. FCFF4 divided by, or FCF3 into 1 plus G, both are same. Okay, let me write that only. FCFF3 into 1 plus G divided by KO minus G. This will give you terminal value. This you multiplied by discounting factor of third year. 1 by 1 plus KO whole to the power of 3. And this part is what the whatever in the brackets is what I mean as terminal value, TV3. When I use the fourth year cash flow, I get third year terminal value, one term less, and multiplied by discounting factor. So 1 by 1 plus KO whole to the power of 3. This is if it is growth become constant after particular period, multi-stage discount model. Anyway, while solving the problems, you don't worry about these formulas. You will write in a tabular format, but conceptually be aware of this equation format. RF and RM, risk-free rate and return of market rate. Okay, value of firm. Is it done? Shall I go further? Okay, next. Value of equity. Okay, now value of equity is in one easy formula. We'll say that it's value of the firm minus value of debt. This is one formula, simplest, and which is what used mostly practically also. Value of the firm minus value of the debt. Or the straight big formula, detailed calculation formula, that is FC FE 0 into 1 plus G, or FCFE 1, FCFE into 1 plus G divided by KE minus G. Remember, it's not KO. It's cost of equity only. Why? Because when you value the firm, we need overall cost. Debt also, equity also mixed. But when you say equity, you need only cost of equity, only from the equity shareholders' point of view. So be careful about the cost of equity. This is perpetual growth, or if it is growth becoming after a particular year, same formula like what we discussed here. This value concept, same thing applies. You don't have to repeat it every time. This much is sufficient. Now, both of these term, mathematically answer will be different. Conceptually same, mathematically it will be different. So in the exam, you write mostly it's preferred. This in a full-fledged problem, we follow this. Value of the firm, value of debt is usually applied for full-fledged problem. Practically also, if you follow this, is applied for full-fledged problem. But sometimes they'll tell you compute value per share, and they give you this information directly, like capital expenditure, depreciation per share, straight away they give. In those cases, you can use the second formula. But be aware of both. Why K for cost of capital? That's again your intermediate level question, maybe because you had a separate chapter called as cost of capital. It's because of its pronouncement. K. So instead of C, we use the term K, and also because of the influence of other language, the Latin has got impact, because in Latin, again, cost is influenced with K more than C. That's why K is used, because pronunciation is cost. Though we write C, pronunciation is cost. Okay, not relevant for my subject, but let me ask you one basic question. Since you're all becoming chartered accountants, you should know absolute everything about the accounts. Let's see if you can think about this answer. We use the form for debit credit. What is the short form we use? For debit credit, we use the form DRCR, right? Debit, DR, credit, CR. But where does R come from? Debit, I understand D. Credit, I understand R, C. But where is R come from? Don't tell me debtor, creditor. No, that's not the reason. For debit, credit. Debit, we have D. Credit, we have C. But where does the R come from? Any idea? Anybody ask this question? Why R? We're writing debit. Where does R come from? Chumma, you add any alphabet you want. Okay. I will not answer that question. You try to figure it out. There is a answer very close to the answer what I've just given. Why? KE stands for costs, or K stands for cost. Seems good to know. Why R only? We can use anything. No, why R only? At least credit we understand, because CR, credit, okay. But debit, where are coming from? Okay. Anyway, you try to figure it out. Or okay, I think some of you are very keen. I'll just give a quick answer, simple answer. It's because of its history. In Latin, debit they call it as debire. In credit, they call it as credire. Latin, debire became debit, credire became credit. My pronunciation may be wrong, but that's how it's approximately. So debire R comes from there, debit, credit. So this impact of Latin is there much on our English. Anyway, so let's go further, my dear friends. So what I was trying to tell you, value of equity is value of the firm minus value of debt. That approach we mostly use. But you can also use the approach FCFE 0 into 1 plus G by K minus G, some straightforward problems where they'll give you everything per share directly. In that case, you can use the second method, but mostly you'll follow the first method. Okay. Now let us go to the format that we need to keep it in mind for full-fledged problems. Income statement, because practically people do follow this. So they will give you income statement and ask us to estimate. So I would like to spend time on that. Format, what you need to keep it in mind. Income statement or valuation using projections. Valuation using projections of income statement. I'll give you the format, and if possible, if I get it, I'll try to show you the practical example as well. Okay, so they will give you year 0. Okay, year 0, you always take it as base data. Don't consider it for present value calculation. This is base year. This you should not use it. I mean, this is used for ratios, but that should not be used in present value calculation. Okay, so let's say year 1, we will have year 2, we will have year 3, and year 4 onwards for example purpose. Year 4 onwards, where growth become constant. Practically what we do, for 2-3 years, maybe 5 years, we can do lot of calculations and try to do some projections, but after a particular point we cannot do lot of calculation. We assume a constant rate, means we get a terminal value at that point. So what and all will have it? We will have sales. They will give you sales of year 0, but based on year 0 we calculate the growth, and to be specific, I'll say 1 plus G. Sales they will give you, or whatever, let's say year 0 sales, then you multiply with 1 plus G, growth rate. They will tell you sales is likely to grow by 20%. You get sales of year 1. Again you multiply it by 1 plus G. You get next second year sales, and so on. Of course, 4th year onwards, sales growth might get stabilized. Then you will have expenses, cost of goods sold, I'll say. You'll have depreciation and all. You get EBIT, whatever. I think I'll write XXXX. Cost of goods sold. X means some amount, okay, not cross. EBIT. Less interest, should I do or not? Less interest, should I do or not? It should not be done for valuation of firm. If you are computing value of equity, net profit, then we do it. But typically when we discuss, we only discuss from FCFF, free cash flow to firm point of view, then I subtract it. So typical problem, I don't subtract interest. But if you are calculating FCFE method, then you subtract. But usually I don't do it, so I just subtract tax. So what I get is net operating profit tax, no tax. Then I'll add depreciation minus capex, capital expenditure, minus increase in working capital. So no PAT I get. Depreciation you add. Capex you subtract. Increase in working capital, increase in WC, increase in working capital, you subtract. Then what you get is FCFF. This is FCFF1. This is FCFF2. This is FCFF3. This is FCFF4. Now FCFF4 I should not stop. What should I do? I have to calculate TV4. No, TV3, sorry, TV3. That is FCFF4 divided by KE minus G. I'm not sure you are able to see this. FCFF4. So yeah, 4 divided by KO minus G. KO minus G. Then you multiply it by discounting factor of year 1. You multiply it by discounting factor of year 2. You multiply it by discounting factor of year 3. This also you multiply it by discounting factor of year 3. Then whatever the total present value you get, PV, is value of the firm. So FCFF multiplied by discounting factor, last year terminal value, then you get value of the firm. The terminal value part I'll read in case you're not able to read correctly. So FCFM, FCF1, FCF2, FCF3, FCF4, where the growth becomes stabilized, and FCF4 divided by KO minus G. FCF4 by KO minus G, you get TV3. TV3. So then you multiply for this DF1, DF2, DF3, and for last one also DF3 only. Last two cash flows will have same discounting factor. We have discussed this in multi-stage dividend discount model. Then PV, value of the firm. Total of all this is value of the firm. Let me see if I have any. Okay, just give me 1 minute. Let me see if I can get you. Something practical where I just want to show the formats. Okay. Can you please confirm if any Excel sheet is visible? Yes, right? Okay. So this is how practically, like lot of equity research firms, brokerage houses, when they give you buy call, sell call, they use this format. For example, this one of the companies thing you see for the last few years, March 2013, 14, 15, 16, 17, 18, 19, 20, they are having the actual data. And from 21, 22, 23, 24, 26, they are doing some estimation data. So from the actual data, they compute the ratios. Using the ratios, they're trying to project revenue, other income, total sales, and for revenue also, they do separate calculation in your annual report. So many data points will be there, like revenue from North America, Europe, how much was percentage, applying the same percentage because geographically growth rate might be different, segment wise revenue, even product wise segment they will do it. Revenue in USD INR they will do it, revenue by delivery centers. Okay, cost also they will project, employee cost separately, professionals cost separately, interest expense separately. Then they prepare the asset schedule to know the capital expenditure. They try to do all these estimations of balance sheet estimation they will do, cash flow estimation they will do, cash flow format. Then they will do the DCF calculations, discount cash flow. Cost of capital and all, how I told you, risk free rate, growth rate, RM, beta. They use all those ratios. They compute the cost of equity, WSEC, WE, cost of weight of equity, weight of debt. Then I told you EB 18 to 1 minus T, no PAT, depreciation, purchase of fixed assets. This is practically done, my dear friends. This is a practical example how exactly the valuations are done. Then they do a calculation, FCFF, then they calculated enterprise value, value of the firm. Then they subtracted debt, net debt they subtracted, so minus debt plus cash, net debt. They got the value per share. That is what they are telling. I mean, they divide by number of shares, that will give you the value per share. Then they compare with the market price and they give the decisions like sell, hold, buy, etc. And whenever a result comes, quarterly results comes, these valuation change drastically because these estimations what is there, that will become actual to an extent. So because of the change in estimates, change in values, the value per share will change. And this is what typically we call it as fundamental value or fundamental analysis, looking at the fundamental value of the stock. So as per this calculation, if the value of stock comes to 1000 rupees, but in the market, if it is available at 800 rupees, we know it will come to 1000 rupees one time or the another. It's a good to buy. Or if it is a higher price, we say don't buy it. Or if you have it, we sell it. Or if you are already holding it, we give a call like hold call. So various kind of this analysis comes from these calculations. So much data point will be doing it. In the practical life, so much calculations will be involved. It's not like simple one PPT, one slide we got the answer, one table we got the answer. It is not like that. We will be doing estimating P&L account separately, balance sheet separately, and balance sheet should get tallied, and cash flow statement we prepare, and revenue estimations will have all the segment revenue. That's why what you read in India's AS annual report information becomes so much relevant. Director's report guidance becomes so much relevant. We use these data points, plug in these Excel models, we'll arrive at the numbers. And the same Excel model cannot be used for all the companies because the different companies will have different revenue structure, will have different cost structure. So we can't use one Excel model for all, but conceptually is what I wanted to show it to you how these detailed practical calculations are done. It's not a simple one table thing. People spend months together to understand, to do data crunching and come up with the value. And of course, once a company, one Excel sheet is there, then every time annual report comes, we just have to update. Excel formula works, change any assumption you want, the value of the share will be obtained automatically. Okay, so let's go back. I want to discuss one more point before we go to problems. Okay, so I hope PPT is back. Is PPT visible? Yes. Okay, very good. Thank you. So what we discussed is so much. One point to be kept in mind, sales growth, I told you. How do we calculate this EBIT? How do we calculate tax and all? Okay, that is fine. But how do we get these numbers futuristically? How do we estimate? Is what I wanted to tell you. For practical understanding, kindly share the Excel sheet. Sorry, that will not be able to do. Uh, you can search in Google, you'll find it, because that what I showed you were the practical ones. So that is confidential ones, I will say. I mean, I cannot share it as it is because a lot of effort has gone behind it. So that will not be proper on my side to share it. I can show it to you. You create it. You can search in Google. I'm sure you'll find it. Or if I'll try something, if any something demo is available, I'll search in my file section. If it's available, that I'll share it with. Okay. Um, okay. What I was telling is, how do we use the estimations? Estimations are done. Exam purpose, I'm telling. Practically, a lot more things goes in. Examination point of view, estimation comes from the base date. Information they'll give you, sales growth, that is the primary information they'll give you. Okay, so I'll just tell you for that purpose as well. How do we do it? So sales growth information will be given in the problem. Sales growth, this will be given in the problem. Practically, a lot of calculations goes in, segment revenue, currency revenue, and so on. So exam point of view, sales growth will be given in the question. Okay, then comes to this cost of goods sold percentage or EBIT percentage. We can directly go to EBIT actually from exam point of view. EBIT percentage calculated from base year information. Calculated from base year. That is given by EBIT divided by sales into hundreds. Base year we take it. Year zero. Base year means year zero. That information they'll give in the problem. Year zero information. They'll give the problem. So sales growth is done, EBIT done, a tax rate anyway will give me the problem. So no part we will calculate. Come to depreciation, capex, working capital. How do we calculate this part? That is very, very essential. What is common in the exam I'm discussing with you? Capex. Again, calculated based on base year. Calculated based on base year. That is, we use turnover ratio, asset turnover ratio assumed to be same. That is, we will use turnover ratio. Turnover ratio. And if you remember turnover ratio, okay, let me give an example. Suppose a fixed asset is, let's say, 40,000 and sales is 2 lakh. Sales is 2 lakh. So if I typically compute the fixed assets turnover ratio, how much it will be? Fixed assets turnover ratio. How much it will be? How do you calculate? Sales by fixed asset. Remember, turnover always will come in the numerator. FATR, fixed assets turnover ratio. That is, sales is 2 lakh divided by fixed assets 40,000 equal to 5 times. How do you understand by this 5 times, my dear friends? If one sales by fixed assets, if 1 rupee is fixed assets, 5 rupee will be sales. Sales by fixed assets. Denominator 1. So if fixed assets is 1 rupee, sale will be 5 rupees. So if I know the fixed assets, I'll be able to compute the sales. If I know the fixed assets, I'll be able to compute the sales. But will that be there in this question? We will have sales typically, right? Sales growth. See the first line, sales growth we will have. So we will know future year sales. So if from the sales, if I have to come to fixed assets, I should divide by this ratio. I should take a reciprocal of this. Because from the sales, I'm trying to compute the fixed assets. So rather than this, we can do, this is technically, but for solving problems in exam, even institute has done it, we don't follow this approach, we will follow percentage approach. That is fixed assets as a percentage of sales. Means what? 40,000 is the fixed asset, sales is 2 lakh, so into 100, so we get 20%. What do you mean by 20%? Whatever the sales, if I apply 20%, I get fixed assets closing balance. So, right, correct, right? Fixed assets as a percentage of sales, I get the closing balance. So, I know the sales, I multiplied by this percentage from the base year, I'll be able to calculate the fixed assets. So, rather than turnover ratio method, we follow percentage of sales method for easy, convenient calculations from exam point of view. Okay, but this is closing balance. This fixed assets, what we get is closing balance. But we want is increase in capital expenditure. How much fixed assets purchased during the year? For that, one more information will there. Let's say depreciation. Depreciation, sometimes they will give you directly in the problem. Sometimes. So I'll write like that only. Sometimes they will give it to you, right? Like capex net depreciation growing at certain rate. Sometimes capex or net capex, they'll say. Sometimes they'll say net capex growth will be given in the problem. Given in the problem. If they have given, no problem. You use it as it is. Capex, net capex means what? Capex minus depreciation. You calculate for the base year. Growth they will give you. It grows by 20%. Keep adding 20% every year. Depreciation, you will come to know about it. But sometimes we have to calculate. Sometimes we have to calculate, and you know how much will be the calculation. Depreciation will be calculated as previous year or opening fixed assets, previous year closing balance, or opening fixed assets means previous year closing balance into rate of depreciation. Opening fixed assets into rate of depreciation. Okay. Then we need to calculate the capex increase. I would like to take one quick simple example. Please make sure you write it till here. Then I'll give a quick numerical example. Because we need to estimate capex, we need to estimate depreciation, and we need to estimate increase in working capital. With that, basics discussion will be over. We can go for problems. Are you done till here? Okay, one small numerical I'll take. Suppose sales in year 0 is, I'll take same example, let's say 2 lakh. Fixed assets is 40,000. And sales growth, let's say 20%. A rate of depreciation, let's say 10%. So how do you calculate here? Let us do for 1 or 2 years. Year 1, what will be sales? 2 lakh growing at 2%. 2 lakh into 1 plus 0.2. That is 2,40,000, right? Year 2, 2,40,000 into 1 plus 0.2. 1.2 you are multiplying. 1 plus 0.2. Growing. I'll do for one more year maybe. How much you get? $288,000. One more year, you tell me. Year 3. Same growth rate, 3,45,600. Okay. Fixed assets. How much will be fixed assets as a percentage of sales? As I told you, 40,000 divided by 2 lakh into 100. 20%. Okay. Easy to calculate. Okay. This also happened to be 20%. No problem. So fixed assets will be how much? 2,40,000 into 20%. 2,40,000 sales into 20%. 48,000 fixed assets. Then the next year 2,88,000 into 20%, because fixed assets is 40% of sales or 20% of sales. $57,600. Year 3, 3,45,600 into 20%. 69,120. Okay. Now, can you tell me what will be the depreciation for first year? Rate of depreciation, I told you 10%. Please calculate and tell me how much will be depreciation for first year. How much will be depreciation first year? It is not 4,800. Why? This is closing balance. Fixed assets closing balance, my dear friends. I want depreciation for the year. That's why I clearly told you while calculating, it is opening a fixed asset into rate of depreciation. So what is the opening value of fixed assets? Year 0 value. Fixed assets was 40,000. On that, you apply rate of depreciation 10%. That becomes 4,000. Are you getting it? Now, can you tell me for next year how much it will be? For year 2, on 4,800, 10%, that is 4,800. 48,000, 10%, 4,800. Previous year closing balance, current year opening balance. Then similarly, 57,600 into 10%, and that is 5,760. I hope you got the clarity here. Depreciation, what common mistake people do. We should take the previous year amount. Okay. What is more important is how much is purchase of fixed asset. This is the capital expenditure. Can you tell me how much is the purchase of fixed assets? That means what I'm asking you is, opening balance of fixed assets was 40,000. Closing balance is 48,000. So in first year, opening balance 40,000, closing balance became 48,000. So what should have been the purchase? 40 becoming 48, you tell 8,000. But there is also depreciation element to be considered. That is what I wanted to discuss with you. Now you tell me, depreciation, you add, you subtract, or you ignore? Depreciation is added, subtracted, or ignored. Okay, I'll do one thing. I will prepare one simple fixed assets. Okay, first year I'll prepare ledger, fixed assets. Opening balance, two balance brought down. opening balance is 40,000. Closing balance by balance carried down, balance at the end of the year is 48,000. Depreciation for the year. Can you tell me where do I write? By depreciation or to depreciation? In fixed assets account. I hope you know this much accounts at least. Where do I write depreciation? In the credit side or debit side? By depreciation, right? Credit side. So depreciation, I write on the credit side by depreciation, and that is 4,000. Now balancing figure is my purchase, correct? How much is balancing figure my purchase? 48 plus 4 minus 40. That is 12,000. That is my purchase. Now you tell me, if I am doing the calculation, 48,000 minus 40,000, if I am doing the calculation, closing balance minus opening balance, will I add depreciation or will I subtract depreciation? 48 minus 40, that is 8,000. You know the answer should be 12,000. So obviously we have to add 4,000. So the formula, if you want to write, purchase of fixed assets is closing balance minus opening balance plus depreciation. That will give you 48,000 is closing balance minus 40,000 is opening balance plus depreciation for the year 4,000. And that's how first year you get purchase of fixed assets 12,000. Similarly, second year will be closing balance 57,600 minus opening balance 48,000 plus second year depreciation 4,800. Can you tell me how much will be second year value will be? You can tell me. Closing balance is 57,600 minus previous year opening balance, previous year closing balance is 48,000 plus depreciation 4,800. 57,600 minus 48,000 plus 4,800. 14,400, right? Second year, 14,400. Okay. Here also, I would like to tell two beautiful points. You can do similarly for third year. Why should I depreciation to be added? Logically. I understood accounting wise, I understood mathematically. Logically, I'll tell you. Closing balance of 48,000 is after charging depreciation because closing balance means after charging current year depreciation. Charging means what? After subtracting. That is what? Opening balance 40, closing balance 48,000. There is an increase of 8,000 after subtracting 4,000 because closing balance is after charging depreciation. So there is an increase in spite of decrease of 4,000. That means how much you should have purchased? 12,000 should have purchased because 4,000 went for depreciation, net increase 8,000. Did you get the logical aspect? There is an increase in fixed asset by 8,000 in spite of depreciation having negative impact. So how much you should have purchased? 12,000. Then 4,000 went for depreciation. So 8,000 is the net effect on the closing balance. Are you understanding why I'm adding? Because it was already subtracted. Hope you got the things conceptually right. Okay. Now one beautiful point I would like to tell. If you follow this approach, remember this approach, plus depreciation minus capex. How much is plus depreciation? First year we calculated 4,000, capex 12,000. Okay. So depreciation 4,000 I will be adding, capex 12,000 I will be subtracting. What is the net impact? Can you tell me? Net impact. I'll subtract 8,000, right? I will subtract 8,000. Okay, second year, what is the case? Second year, depreciation 4,800, purchase 14,400. Tell me the net amount. 4,800 I will add, 14,400 I will subtract. Tell me the net amount. 9,600. Okay, 9,600. Thank you. Now, this net amount is nothing but change in fixed assets, right? What is fixed assets? For 40 becoming 48. 40 becoming 48. 8,000 is the net impact. 48 becoming 57,600. 9,600 is the net impact. Because fixed asset from opening balance to closing balance is because of two reasons. One is a purchase, other is depreciation. Anyway, we assume no sales. So instead of taking depreciation separately and purchase separately, I can take the net amount, right? Net capex. Difference between opening balance, closing balance gives you the same answer. And that is why in some problems, if you remember, I told you while calculating free cash flow, we understood this concept of net capex. Remember, we have discussed this net capex, capex minus depreciation. This was the reason behind it. Anyway, in the problems, you will be able to understand better. Let me just give you one last point. After that, we can go for problems. Okay. So capex we understood. How to calculate purchase of capex we understood. Depreciation we calculated. Only thing is working capital. This is also percentage of sales. Calculate based on base year. Calculated from base year. That is we can also do turnover method. We don't follow turnover method. We follow percentage method. So working capital divided by sales into 100. Working capital as a percentage of sales. Whatever percentage we get. Working capital as a percentage of sales. So this percentage, if I apply it on sales, I get working capital this year. Next year sales into this percentage, I get next year sales. Next year sales into percentage, I get next year working capital. So once I get every working capital, the difference between 2 years will be my increase in working capital. So that is not a problem. Difference between the working capital between 2 years will give me the percentage. So this is the overall approach of FCFE calculation. I'll give you 1 minute. Let me know if you have any doubt, because after this we'll take a break and then we'll go for problems. Any question? Okay. I'm not getting any question. Very good. Okay, so come to this problem. Calculate the value of Avenger Limited from the following information. Equity capital of the company 1200 crores. Profit of the company 300 crores. Par value of share 40 each. Debt ratio of the company 25%. Long run growth rate of the company 8%. Beta 0.1. Risk free rate 8.7. Market return 10.3. Change in working capital per share rupees 4. Depreciation per share rupees 40. Capital expenditure per share rupees 48. So what we have to calculate is value of share. Value of share means value of equity we have to calculate. We don't have to prepare income statement and all here, because we don't have many years calculation. So 1 year FCFE we calculate, and FCFE by K minus G we can calculate. Okay, let's calculate that. Okay. First we'll calculate FCFE here. FCFE. Write the formula first. Profit after tax
minus, if you take common, we will have to take common, the capex minus depreciation plus increase in working capital multiplied by equity plus debt. Okay, now here look at the information. Everything is per share basis, working capital per share basis, depreciation per share basis, capital expenditure per share basis, but profit is not given per share basis. Let's calculate. One note on that. Profit of the company 300 crores divided by number of shares. Oh, number of shares not given. No problem. Equity capital given 1200 crores. Value per share given 40. We can calculate number of shares. Please calculate 1200 divided by 40. That will give you number of shares. So 1200 by 40. I think you get 30 crore shares. 30 crore shares. Then what is profit per share? Nothing but EPS. Profit per share. Profit of the company 300 crores divided by number of shares 30, get 10 rupees per share basis. 10 rupees per share basis. 10 rupees. So profit after tax, everything per share basis, 10 rupee minus capex per share given 48, depreciation per share given 40, working capital per share given 4 rupees into equity by equity plus debt. We require equity ratio, but what they have given? Debt ratio 25%, 0.25. Debt ratio 0.25. We need equity ratio, so I'll do 1 minus 0.25 because we need equity ratio. Equity ratio is 1 minus debt ratio. Close the brackets. So you get 10 minus 40 minus 40 is 8. 8 plus 4 is 12. 12 into 1 minus 0.25 is 0.75. So 10 minus 9, this is equal to 1. Okay, FCFE. We require FCFE by K minus G. Growth rate is given, but we don't have information on cost of equity. Cost of equity not given, so we'll calculate using CAPM. Cost of equity using CAPM. Now, as I told you, only formula I had given you earlier. I'll repeat the formula now also once more, but details of logic and the interpretations we discuss in the portfolio chapter. So RF plus RM minus RF into beta. So RF is risk-free rate given 8.7 plus RM minus RF. Market return given 10.3 minus 8.7 multiplied by beta 0.1. So how much it comes to when you simplify? Ten point 3 minus 8.7 0.1 plus 8.7, 8.86. 8.86. Okay, so we'll have to compute the value of per share. I'll do it here. The blanking here. Value of share V0 equals FCFE. That's what we have used here. FCFE. This for the latest year. So FCFE 0 into 1 plus G by KE minus G. So FCFE 0, that is 1 into 1 plus G G growth rate 8%, 0.08 divided by K minus G, that is 8.86. So 0.8886, 0.0886 minus 0.08. So you get 125.58. Why the debt ratio is 1 minus 0.5? No, debt ratio is not 1 minus 0.5. Debt ratio is 0.25. We need equity ratio. Equity ratio is 1 minus debt ratio. So 1 minus 0.25, we get 0.75. Debt ratio is not 1 minus 0.25. Debt ratio is 0.25 only. We needed equity ratio. How to interpret the value per share? Is it intrinsic value? Yes, it is intrinsic value. Intrinsic value, the value per share according to this model. Market price is always available, and based on market price we can decide. Okay, let's go further.
Okay, hope you got this question. A very nice problem. The valuation of Hansel Limited has been done by investment analyst based on expected free cash flow of 54 lakhs for the following year and an expected growth rate of 9%. The analyst has estimated the Hansel Limited value to be 1,800 lakh. Very nice. They have given the value themselves. Free cash flow 54 lakhs. Growth rate 9%. Estimated value of the firm, of the entity, was on the 800 lakhs given. What else we have to do then? However, he committed a mistake of using the book value of debt and equity. So you are supposed to use market value of debt and equity. The ratio we have to use while computing WSCC, weighted average cost of capital. Preferably we go for market value. If not available, then we come to book value between equity and debt for weights calculation. But he has used book value. Book value weights employed by the analyst are not known. but he has used it. This can happen only in exam. You don't know the book value weights, but you have used it. How is it possible? It can happen in exam. But you know that Hansel Limited has a cost of equity 20% and post-tax cost of debt 10%. KD, already given. Value of equity is thrice the book value, whereas market value of debt is 9/10 of its book value. What is the correct value of Hansel Limited? So this is a reverse calculation that we have to do. Okay. So what is given? Let's write down. Free cash flow, FCFF. This is value of entity, value of the firm. So FCFF, 54 lakhs. Everything in lakhs. So I will not write separately. Then growth rate, 9%. And value of the firm, 1,800. Value of firm, 1,800. Now, existing WSCC, not given. But what is used? Weights. Weights are given as book value. But what is required? Required is weights. We should not use book value. We have to use market value. And value of the firm, what they've given? We need the correct value. We need the revised value. They've used the book value of the weights. They've used the cash flow and they've computed the value of the firm. But we require, if I change the weights, what will be my new WACC? WACC will change, new WACC based on market value weights, new. And what is the value, revised value based on that? Hope you understood the basic structure. This is a reverse calculation problem. From the given data, compute the WACC, which is based on the value of the firm, the book value. Then you revise it and you compute the revised value. Hope you're getting the point. So let me use the formula once I'll write it. So what is the value of the firm? I'll just write at the top once for your reference. Value of the firm, I'll say V is free cash flow FCFF1 by KO WACC minus G. Both are same, KO or WACC. Just 1 second. Okay. So let's calculate now using that formula. Value of the firm is given to be 1,800 equals FCFF 54 divided by KE minus G, KO, cost of capital minus growth rate 0.09. Cross multiply KO minus 0.09 equals 54 divided by 1,800. Then 0.09 goes to right side. KO equals 54 divided by 1,800 plus 0.09. So what is this? 54 by 1,800 plus 0.09. So 0.12 you get, I think. This is existing based on book value. I repeat, this is WACC based on book value weights. Based on book value weights. Now we are going to calculate what is that book value weight. We got 12%. We got 1800 they've given. But what is that book value weight? Let's calculate. How do you calculate? Let's write the formula. I'm sure you know it. WACC or KO, both are same. Weighted average cost of capital, overall cost of capital is given by cost of equity into weight of equity plus cost of debt into weight of debt. Now KO is 12%, 0.12. So I'll take it as 12%. Cost of equity they have given. How much cost of equity? Cost of equity is given as 20%. So cost of equity 20% and cost of debt is given as 10%. Post-tax cost of debt. So directly given, we can take directly as 10. We don't require any into 1 minus t because they only said post-tax. So weight of equity, I'll write WE. Please tell me, weight of debt, can I write it as 1 minus WE? Are you able to understand? Because weight, total should add up to 100 if you express in percentage proportion. We only have two things. If weight is, let's say, 60% of equity, debt has to be 40%. So 1 minus I did. Hope you're able to follow it. We have to simplify and see what is weight of equity, weight of debt. Otherwise, you have to solve simultaneous equation and all. This is sufficient. So 12 equals 20 WE plus 10 into, open the brackets, 10 into 1, that is 10, minus 10 into WE, that is 10 WE. So 10 comes to left side, 12 minus 10. 20 WE minus 10 WE, that becomes 10 WE, I think. So that is 10 WE equals 2. So WE is 2 by 10, that is 0.2 or 20%. Please check the calculations, so the numbers are fine. Okay, hope you got it. Things are fine. So weight of equity is 0.2. So weight of debt is 1 minus of this. 1 minus 0.2, which is 0.8. Okay, hope you got it. This is the book value. What we got now is book value. Now we are going to change this weight into market value. We get the revised weights, and based on the revised weights, we are going to do the revised value of the firm. Shall I go to next slide? Please confirm. Okay, I'll go to next slide. So revised weights now. Revised weights, equity and debt. Equity we got 20%, 0.2, 20% you can say. And debt we had got 0.8, which means 80% you can say. And what is the market value they're telling? Value of equity is thrice its book value. So it will be into 3. Value of market will be equity will be thrice, 3 times 60. And debt is 9/10 book value. So debt equals 9/10, 9 by 10th. That is the 72, I think. So that will be the new ratio, new weights. So the new weights are 60 by 60 plus 72. And here 72 by 60 plus 72. That will be the new weights considering the market value. So revised WACC or cost of capital equals cost of equity is 20%. Cost the weight of debt 60 by 132 plus debt is 10% into 72 by 132. Simplify and see how much you get. 20 into 60 by 132, 10 into 72 by 132. Is it 14.55 something? 14.545, round it off, 14.55. 14.55. So value of the firm, revised value of firm. Again, same formula, Fcff1 by Ko minus G. Fcff1, that is same as previous, 54. Ko revised one, 14.55, means 0.1455. Growth rate 9% minus 0.09. 54 by 0.1455 minus 0.09. 0.05555. 54 by 0.0555. 972.97. 0.1455 minus 0.09. 0.0555. 972.97. I think these are all lakhs. So ultimately, you can present the answer in lakhs. So this is one rectification problem. It has not been asked in the exam many times, but it's part of RTP, MTP many times. Are you able to see the PPT? Something wrong with the system here. Is it fine? PPT visible? Yes. Okay, very good. Any doubts? Any questions? Okay. So hope you got this one. Good. Did you get the question? Next one. Following are the details available for X Limited sales, gross margin, accounting, administration, distribution expenses, profit before tax, tax, profit after tax, balance sheet information, fixed assets, current assets, equity, sundry creditors, total liabilities. The company is contemplating for new sales strategy as follows. Sales to grow at 30% per year for next 4 years. Asset turnover ratio, net profit ratio, tax rate will remain same. Depreciation will be 15% of the value of the net fixed assets at the beginning of the year. Required rate of return of the company is 15%. Evaluate the viability of the new strategy. First of all, I hope you got the question. Okay. Uh, Now, first of all, we have to calculate FCFF or FCFP. That you have to keep it in mind. Of course, format will be same. If it is FEFE, at the end we subtract the debt. Apart from that, format will be same. Okay. They're asking evaluate the new strategy. Now you tell me, are we thinking from the business point of view or the owner point of view? New strategy. Now, does it matter whether you take debt or equity? The strategy is not capital structure. Strategy means maybe marketing strategy, maybe some say advertising strategy. So, this is from the point of view of business. Should you accept a strategy or not? Whether you fund this strategy by debt or equity, that becomes your capital structure decision. That is from owner point of view. So when they tell you strategy, it is FCFF, business point of view, asset point of view, firm point of view. So we have to calculate FCFF. So we have to calculate year 1, year 2, year 3 for next 4 years. So how do we follow it? 1 second. So tell me, what will be your columns? From when the cash flow getting stabilized? From when the growth rate will get stabilized? Sales will grow at 30% for next 4 years. What about 5th year onwards? No growth. So you will have cash flow for 4 years, growing at sales 4%. 5th year onwards, cash flow will stabilize. I mean, cash flow will become constant. So you will have how many columns? Year 1, year 2, year 3, year 4. Because 4 years growth will happen at 30%. Year 5 onwards, growth rate will stabilize. So we can apply from year 5 onwards. Okay. So we will have year 1, year 2, year 3, year 4, then year 5 column. Sales will be given, margin and all is there. There's a ratio remains same. We can estimate easily, but we need a working note. Working note for 3 things: fixed assets, working note for depreciation, working note for working capital. So let's do that working notes first, and then we can go for the calculations. Just 1 second. Just give me 1 second. Okay, fine. One small point with respect to our observation. You see fixed assets 10,000, current assets 6,000, equity 15,000. Is your balance okay? And okay, creditors 1,000. Okay, fine. Now it is tallied. 15 plus 1, 16, 10 plus 6, 16. Okay. The company does not have any debt. So in a way that is good. Everything is equity only. So we should look at these calculations. In fact, what institute has done, they have prepared the balance sheet for full 5 years. They prepared how much fixed assets, current assets as a percentage they have taken. But we need not worry about it. We need only three things: depreciation, fixed assets, and increase in working capital. So let's focus only on that. So let's do some working notes and then we'll go further towards cash flow projection. Okay, so let's work on working notes. Okay, so first will be sales. You can do base year. Base year is only for information, not for calculation. Then we will do year 1, year 2, year 3, year 4, year 5 onwards. Okay, so base year sales. How much is base year sales? 40,000. And this will grow by 30%. So into 1.3 I can do, into 1 plus 0.3, 30%. So 40,000 into 1.3, 52,000 into 1.3, every year same thing, 67,600, 87,880, 1,14,244. Last year there is no change in growth sales, it will be 1,14,244 only. Sales we have done. Let's use fixed assets. So what is the fixed assets? Base year, they said fixed assets 10,000. So what is the percentage of sales if I take it? Fixed assets percentage of sales. 10,000 by 40,000 into 100 if you want to express in percentage, 25%. So apply the 25% on every year amount, 52,000 into 25%, 13,000, 67,600 into 25%, 16,900, 87,880 into 25%, 21,970, 1,14,244 into 25%, 28,561. Please confirm if these numbers are fine. Okay. Depreciation at the rate of, what is depreciation rate? 15% at the beginning of the year. So 13,000, not 30,000, on 10,000 on the previous year closing balance, current year opening balance. So I think 10,000 into 15%, 1,500. 13,000 into 15%, 1,950. 6,900 into 15%, 2,535. 28,561, 21,970 into 15%. 3,295, let's say 3,296, and next year also 3,296. Purchase of fixed assets, capex. Hope you know this calculation. Closing minus opening plus depreciation. Closing minus opening plus depreciation. So for the first year, I may be showing the calculation. Closing fixed assets 13,000, opening fixed assets 10,000, plus depreciation 1,500. 30,000 minus 10,000 plus 1,500. 4,500. 6,900 minus 13,000 plus 1,950. 5,850. 21,970 minus 21,970 minus 16,900 plus 2,535. 7,605. 28,561 plus 3,296 minus 21,970. 9,887. 28,561 plus 3,296 minus 28,561. 3,296. Growth of fixed assets will be 30% or 25%. We are not calculating growth of fixed assets. We are calculating fixed assets as a percentage of sales. Sales 40,000, fixed assets 10,000. So we got the number as 10,000 by 40,000, 25%. And 25% means if I sales is 100, fixed assets 25. I'm not calculating the growth of fixed assets. Sales 52,000, 25% of that becomes my closing balance of fixed assets. My sales is 67,500, 25% of that becomes 16,900. Did you get the point? We are not calculating the growth of fixed assets. We are calculating the fixed assets at a point in time based on sales. Sales is the primary factor. Everything else is computed based on that. Only sales growth we are calculating. No other growth. Only sales growth. Okay, so these are the numbers. Please confirm if you are getting it right. Depreciation 1,500, 1,950, 2,355, 3,296. Oh, last year depreciation different, is it? Sorry. Sorry, on 28,561. 28,561 into 15%. Oh, 4,284 you get. Sorry. Depreciation you get 4,284. Then this also is 4,284. Sorry. Last year depreciation I did wrongly. Please correct it. Addition to fixtures 4,500, 5,850, 7,605, 9,887, 4,284. Okay, so what we wanted, depreciation, that we got it. What we wanted, capex, that is purchase of fixed assets, also we got it. One more thing we require, and that is working capital. So let's calculate working capital. Current assets minus current liabilities. First, base year. How much is working capital base year? Current asset minus current liabilities. Current assets we got 6,000. Current liabilities creditors we got 1,000. So 6,000 minus 1,000, that is 5,000. Working capital. This also we follow same process. Turnover ratio method. Percentage of sales. Working capital 5,000. Sales 40,000. So 5,000 by 40,000 percentage terms, I think you get 12.5%. And if you closely observe, anyway, we'll calculate, then I'll tell you how you can do mathematically faster. So what will be the working capital? Year 1, sales multiplied by 12.5%. Sales is 52,000 into 12.5%. 6,500. 67,600 into 12.5%. 8,450. Similarly, 10,985. Similarly, 14,281. 14,281. One small observation, if you do, you can check it out. Fixed assets percentage of sales was 25%. Working capital sales as a percentage is 12.5%. So basically half, 25 half. So you can do direct calculation. 13,000 half, 6,500. 16,900 half, 8,450. 21,970 half, 10,985. Like that, the fixed assets divided by 2, you can do working capital. Anyway, that's only a mathematical portion. But what you're calculating is this. Sales multiplied by this percentage, you get fixed assets. Similarly, sales multiplied by this percentage, you get working capital. But we need increase in working capital. So let me find out the difference. Increase in working capital. Difference. Closing minus opening. 6,500 minus 5,000. Like that. 1,500. Then difference. 8,450 minus 6,500. 1,950. 10,985 minus 8,450. 2,535. 14,281 minus 10,985. 3,296. And last year 0. 14,281. Okay. Shall we go for it next? Shall we go for evaluation? Please confirm. Okay, let's go further. For first 4 years, depreciation and increase in working capitals are same. Okay, that is only because of mathematical reasons. There is no specific thing. So when you calculate mathematically, 25% of 15%. I mean, I think mathematically it'll come to that number maybe when you calculate. Let me see, mathematically will it work out. 25% of fixed assets into 0.15, 3.75. Okay, that is because of the percentage. So if you, I mean, mathematically, if you see, fixed assets 25%, depreciation 15%. So 25%, if you take 15% mathematically, 25 into 15%, you get 3.75. And working capital is growing at 30% and it is 12.5. So if you calculate 12.5 into 30%, 0.3, you get 3.75. So percentage wise it comes. So mathematical reason, you don't have to apply anything beyond that. Okay, I'll go further. Let's go for evaluation of strategy of new strategy. Let's do valuation first. I don't have to do base year. I can directly start from year 1, year 2, year 3, year 4, year 5 onwards. Let's start with income statement first. Sales. We already calculated, so I can make use of that. 52,000, 67,600. 87,880. 1,14,244. We can use this comma for thing. Okay. So sales we have done, less expenses. Let me go back. Expenses. Should I calculate depreciation separately? Should I subtract depreciation separately? You can see in the statement, they're not subtracted depreciation separately. So we assume this in gross margin or in the accounting administration cost, everything is already accounted. So let me directly take profit before tax, 6,000 of 40,000. So what is the percentage coming to? Or you can even take profit after tax because tax rate also remaining same. Okay, so let me say profit before tax, 6,000 out of 40,000. I can do profit before tax or after tax also directly I can do because percent is same. So 6,000 is profit before tax out of 40,000, or profit after tax also I can do 6,200 out of 40,000. Which one shall we do? Do you want to do profit before tax and then come to profit after tax, or directly we'll go for profit after tax because the tax rate remaining same? So we can do directly. But anyway, I think let me do either way it works. Let's directly do profit after tax because they said net profit ratio and tax rate will remain same. So let's go for direct ratio then. In working notes, please add that also so that it will be useful now. So net profit ratio, 4,200 is the net profit divided by sales 40,000. How much you get? 10.5%. Okay. If you want, you can do one more line. Before tax, you write one line. After tax, one more line you can do. That is 1 minus t. If you multiply, you get after tax. Same ratio. So I can do directly. In the exam also, you can do it. No problem. So sales we have. So I'll go for profit after tax. I'll leave one line. If you want, you people, you can write it. You can also write cost of expenses, admin expenses, detailed statement you can write. But anyway, ratio remaining same. From exam point of view, we can do directly. Practically, the ratio will not remain same. The amount will change. I mean, different component will have different ratios. Anyway, so let's take 10.5%, 52,000 into 10.5%, 5460, 67,600 into 10.5, 7098, 87,880 into 10.5, 9227, 1,14,244 into 10.5, 11,996. This also 11,996. So 52,000 into 10.5%, you get 5460. 67,600 into 10.5%, you get 7098. 87,880 into 10.5%, 9227. 1,14,244 into 10.5%, 11,996. Okay, so we don't stop with profit after tax. We have to do 3 adjustments. Actually, it's no PAT to be specific. But in this problem, no interest. So both are same. So then we write add depreciation. Then less purchase of fixed asset, that is capex. Then we have increase in working capital. We have done the working note already, so we can make use of that. Depreciation 1,500, 1,950, 2,535, 3,296. 4284. Capex 4500, 5850. 7605 9887. 4284. Increase in working capital 1500, 1950. 2535, 3296, 4284. No, last year 0, I think. 1500, 2535, 230. Okay. So depreciation to be added. Capex and all to be subtracted. Increase in working capital also to be subtracted. Okay. So what we get is now FCFF or FCFE. Both are same in this problem because we don't have any uh, interest, no debt. So 5460 plus 1500 minus 4500 minus 1500. 960. 7098 plus 1950 minus 5850 minus 1950. 1248. 9227 plus 2535 minus 7605 minus 2535. 1622. 11996 plus 3296 minus 9887 minus 3296. 2109. 11996 plus 4284 minus 4284. That's all. 11996. So 960, 1248, 1622, 2109, 11,996. Okay, one small observation, my dear friends. In last year, depreciation and capex both are same. Can you understand logically what could be the reason? You write down till here, think for 2 minutes and see if you can answer that. No capital expenditure. There is capital expenditure. No, 4284 is capital expenditure. Why capital expenditure, depreciation, both are same. Correct. Sales has not increased, but fixed as the ratio should be same. Try to understand. We have sales, okay, and we have fixed assets. Now sales has not increased. Sales is constant, but we want to make sure the asset ratio remains same. Asset ratio means between sales and assets. Between sales and assets, the ratio we want to keep it same. So fixed assets also should be remaining same, but fixed asset will not remain same. Why fixed assets will not remain same? Fixed assets keep reducing every year because of depreciation. But fixed assets should remain same, but it will reduce. How do we set it right? How much our depreciation, how much our fixed assets comes down because of depreciation, we have to increase so that fixed asset remains same. If fixed assets remain same, sales will remain same. If fixed assets and sales remain same, the reason, the impact is whatever decrease in fixed assets due to depreciation, you have to increase it by purchasing it. So when the sales is constant, fixed assets also to remain constant. If you want to make this happen, then amount of your depreciation should be compensated by amount of capital expenditure. It's a very important thing. I'll use it in the later part of the problem. I'll tell you how I'm using it. Okay, so let's go further. So free cash flow to form we got, we have to discount it. Before discounting, I should do one more calculation. Can you think what could be that? Before discounting, year 5 onwards. Remember, 1, 2, 3, 4 is correct. But year 5 onwards is not 1 year cash flow. We have to bring all the cash flows into one place. So what I'm going to do, we are going to calculate terminal value. So this is cash flow of year 5. Cash flow of year 5, 11,996 divided by K minus G. What is cost of capital, required rate of return, required return company 15%. So 0.15 minus no growth rate. So 0.00, no growth rate, 0. So this is which terminal value we get. This is CF5 divided by KE minus G. There will always be one term less. Cash of year 5 means this will become TV4. This will become TV4. CF5 K minus G TV4. Okay. Now we can apply discounting factors at the rate of 15%. Have they given the discounting rate or should we calculate? Okay, so they're not given. Let's take 4 decimals. That's what we do. Actually, institute mostly take 3 decimals. I don't know why, but anyway, I will take 4 decimals. Question does not specify. We can take any number of decimals. Okay, so 1 by 1.15, 0.8696, 0.7561, 0.6576, 0.5717. So 1.8 also we can do. 0.7175. 1.8 I'll do. And last year, what do we do? Again 0.5718 because last two cash flows will have same discounting factor, terminal value at the end of year 4. So discounting factor of year 4 applicable. So DCF, discount cash flow, basically present value, 960 into 0.8696, 834.82. I'll take 2 decimals. 1248 into 0.7561, 943.62. 1622 into 0.6576, 1066.63, 2109 into 0.5718, 1205.93, 11996 into 0.5718, 6859.31. So value of the firm if strategy is followed. Total, you can do total present value. 834.82, 943.62, 1066.63, 1205.93, 6859.31. Something wrong. What is the wrong thing? 11,996 by 0.15. Oh, 79,973. Sorry. Oh, that I wrote wrongly. Sorry. That's not 6849. I wrote wrongly. My mistake. So when you calculate 11,996 by, I think I wrote 1916. 11,996 by 0.15. Terminal value was wrong in my case. 79,973. Please change it. Terminal value is, oh, that I have not calculated. The terminal value, not 11,996. I have not calculated that number. 79,973. That you multiplied by 0.5718. 45,728.56. 45,728.56. I think 49 something you get. 49,779. 780, let's round it up. 49,780. 49,780. Okay. Now, should we, the decision making ultimately, should the strategy be followed or not followed? You should not give judgment only on this, because this is, if the value, if the strategy is followed, you get 49,780 as the rupees. But what if strategy not followed? That also we should keep it in mind. If strategy is not followed, then also you get some income, right? So you can't say you don't get any income. Then also we need to calculate if strategy is not followed. If strategy not followed, no growth. So straight away I can use a perpetual growth formula, CF by K minus G. Let me do that. Value of firm if strategy is not followed. If value of the firm strategy not followed. So what do you think will be the cash flow? We need cash flow, my data. What do you think will be the cash flow if there is strategy not followed? What do you think will be the cash flow of the firm if strategy not followed? Can I say, observe carefully, my dear friends, can I say, if the strategy is not followed, your net profit will be always 4,200 because sales is not growing, ratio of expense remains same, tax rate remains same, sales is not growing, so profit also will not grow. Profit will be fixed at 4,200. Profit will be fixed at 4,200. Can I say cash flow also 4,200, or should I add depreciation for this? What do you think? If strategy is not followed, net profit will remain same. No doubt about it. So should I take this net profit itself as cash flow, or should I add depreciation for this to convert from profit after tax into cash flow? What is your opinion? We are talking about cash flow. Should I add depreciation? That is my question. This is profit after tax. Should I add depreciation to get the cash flow? Okay. Even if you add depreciation, I will subtract one more thing. What is that? Capex. One point I just told you, my dear Gajni friends. I know you believe first in, first out. I just told you, when the sales stops, when the sales growth stops, the sales and fixed assets ratio to be maintained, but fixed assets will come down because of depreciation. So we have to purchase fixed asset to maintain fixed assets. So when there is no growth, decrease, that is depreciation and capex will be equal. So when there is no new sales strategy, which means there is no growth in sales. So capex addition Depreciation addition and capex subtraction will compensate each other, will offset by each other. So no need to calculate. We can simply take directly net profit itself as cash flow. So 4,200. No growth rate. So 0.15 minus zero point 0. No growth rate 0. That itself is the value of the firm if the strategy is not followed. No need to add depreciation, because you add depreciation, you subtract capex, which will be equal. So directly you can take profit after tax by 0.15, you get 28,000. So value of the firm is more when the strategy is there. So we can also say incremental value if strategy is followed. Sometime in the exam they can ask you incremental value difference. 49,780 minus 28,000. Additional benefit you get 21,780. So you can say it is recommended to follow or to adopt the new strategy. It is recommended to adopt the new strategy. Okay. So hope it is done. Shall I go further? Is it completed? This was cash flow by K minus G. No growth. So I've taken 0. K minus G. Cash flow by K minus G. Okay. Hope it is done. Good.
Moving on with respect to the valuation. Broad valuation we have done, various kinds of valuation, even dividend based valuation. Minute concepts are there which can still be asked in examination, because I told you valuation has got different phases. So value added, few methods are there. One is called as economic value added, which is the most important one. Then we have market value added. Then we have shareholders value added. We'll understand one by one. First, we'll go for economic value added. What is this economic value added? EVA. It is like difference between accounting profit and economic profit. What is the difference between accounting profit and economic profit? Imputed cost. That is the opportunity cost. Accounting profit does not take opportunity cost into consideration, whereas economic profit will take that also into consideration. To give you a simple example, suppose you do a business. Let's say you are in a restaurant business. You're in a restaurant business and you make a profit of 10,000. You make a profit of 10,000 and you yourself, in a restaurant business, you make a profit of 10,000 and you work yourself as a cashier come manager. so that you don't pay to anybody else. You work as cashier, you work as manager, and your hotel makes a profit of 10,000. You sell this business to somebody. Somebody acquires your restaurant business. But somebody is a multinational company. So they appoint a cashier because you no longer will be there, and they appoint manager because you no longer will be there, but somebody should do those work. So in this case, can you tell me, will the 10,000 amount of profit remain same or not remaining same? Other things are equal, no other changes are there, all the operations are assumed to be same. Do you think the profit of 10,000 will still be earned, or profit of 10,000 will come down? What do you think? It will definitely come down, right? Because this profit is before considering cashier salary, before considering manager salary. So now this 10,000 profit you compute from investor point of view, personal point of view. But had you compute from the entity point of view, even the cashier opportunity cost, somebody else would have been worked, you would have considered that as cost. Manager, somebody else would have been worked, that would have been considered as cost. So economic profit will consider this imputed cost, opportunity cost also into consideration. One more example I'll give you. If you invest in fixed deposit, let's say you had 1 lakh. You invest in fixed deposit. Let's say you invest in FD 1 lakh, you would have got interest of, let's say, 5,000. Instead, you invested in, let's say, mutual funds. Now, minimum 5,000 you have to receive. Let's say you received 6,000. So what is the extra profit you got? What is the profit which is attributable to mutual funds alone, which is 1,000? Hope you're able to get the point what we are trying to do here. Yes, that is what is economic value added. Anyway, I'll explain you. I just gave you the concept of opportunity cost is also relevant not for the accounting purpose, but for the pure investor purpose, for the business purpose, for the entity purpose. Okay. I'll give you simple examples. You go to office at 10:30. Do you think it is late or it is early? Anyway, no need to answer. Some people say late, some people say early. It all depends on how you manage the expectation. What do you mean by that? Every day you go at 10 o'clock. One day you go at 9:30. Your boss will ask you, hey, 10:30, why 8? Every day you go at 11 o'clock. One day you go at 10:30. Same boss will ask you, 10:30, why so early? So it's all about managing somebody else's expectation. So if somebody asks you, what is the definition of happiness? What is the uh, equation of happiness? I know the definition of happiness of CS students is the balance sheet getting tally, but real meaning, or if I have to put a mathematical equation to a happiness, for me, it is the difference between what you get and what you expect. A person, a student who scores 70 marks may be happier if he was expecting 60 marks, may not be happier he was expecting 80 marks. It's all about the difference between what you expect and what you get. So either work on getting more or expect less, you'll always be. Don't think it's a philosophy and all, but it's my job to tell you one or two sentences. Want you take it, otherwise you leave it. So life is not about comparisons at all. The more you compare, the more expectations you build, and you will feel more unhappy. Always focus on yourself. Some person was very unhappy because he was not having shoes to play, maybe to play football. And some other person was not happy because he was not having the leg tall. So different people will have different benchmarks. Don't compare your life with other life. It's not going to be worth it at all. Anyway, so simple definition of happiness, it's difference between what do you expect and what do you get. Maybe in a standard costing analogy, we can also say standard costing, difference between standard cost and actual cost, that is your variance. Anyway, let's come down to the main formula here, the difference between actual profit and expected profit. Now, as an investor, shareholder or an investor would have, or any person would have started the business taking some amount of risk. I want so much of return, or I taking so much of risk. For this risk, I need to get that return. If I am able to get more than that return, that is what is economic value added is all about. I'll just give you one more simple example. I forgot to give earlier. I'll just give it to you. How the expectation works and how the disappointment also works. As you know, I'm a rank holder in all the three levels. In one of the functions, my relatives asked me, you got all India rank. Which rank you got? I told I got 39th rank in final. You got 39th rank in final? Okay, very good. It's all India? Yeah, it's all India only. So how much percentage you got? I told 59%. They'll be like, oh, second class. Ah. So you understand, right? People's expectations are different. So you don't try to meet everybody's expectations. You can't do that. You always focus on what you need to do. You can't explain how CA, how 50 marks and not people reaching hundreds and show their bats in crickets. Here, after reaching 40 only, we want to show our face to entire world. I mean, our life is different. So don't really bother about what relatives says, what friends says. You are in a difficult situation. I completely understand at this stage of your life, especially CA fan students doing articleship, where you don't know whether you're an employee or you're a student. Your non-commerce students friends, your engineering students who are with you in the schools, colleges and all, I mean with the, or your cousins, relatives, they would have got settled. You're still struggling, difficult life. They were in a relationship, you're doing CA. They broke up, you're doing CA. They completed their studies, you're doing CA. They found one other person, you are doing CA. They got married, you are doing CA. It happens. Everybody's life is like that. Don't think that only your life is like that in CA. So as I told you, if you want to become something different, you should do something different. By doing what everybody does, you can't expect what everybody is not getting. You want to be special, do something special. Okay, anyway, so enough of extra again. Let's come back to this. So difference between a businessman and investor, what he expects and what he gets, that is what economic value added. In a way, you can remember it like a happiness. How do you get actual profit? No pat. No pat, we have discussed earlier. Net operating profit after tax. How do we get net operating profit after tax? That is EBIT into 1 minus T. That is, if interest was not there, if the debt was not considered as a outsider's funds, debt is also a part of the entity, equity also part of the entity, meaning the interest part is not considered as expense. Instead, interest and dividend are considered as appropriation. That is, as if debt is not there, or other way of understanding, if debt is converted into equity, what would be the value of the business, value of the entity, value of the firm? And expected profit, how do we calculate? On the amount of capital employed, how much the cost, the risk is involved. That is called as the WACC, weighted average cost of capital. WACC, weighted average cost of capital. on the amount of capital employed, amount invested in the business, how much return you expect considering the risk involved and various types of uh, funds you have borrowed, like cost of equity, cost of debt, cost of preference share, cost of banking loan, etc. So on the amount invested, how much return you expect is expected profit calculated by capital employed into WACC. NOPAT is calculated by EBIT into 1 minus T. It can also be calculated as PAT plus interest into 1 minus T. What is this logic? We are calculating the profit purely operating profit. We don't want financial expenses. That's why from operating profit only we multiplied by 1 minus T. That is one method. Another method, okay, we computed profit after tax, which means interest is already subtracted. Now I will add back. Not only I'll add back just the interest. For computing the coverage ratios and all, I just added the interest. But here I will do into 1 minus T also, because when I computed PAT, I subtracted interest, even I have considered the tax benefit on interest. Now, if the interest no longer there, then you will not have that tax benefit also, you have to remove it. I'll explain you other way around. You will understand better, I'm sure. Currently, you are having interest expense. Suppose if loan becomes equity, debt is no longer there. Will you pay interest? Will you have that expense? Obviously, no. So, when you don't have interest, your profit will increase. You save interest expense. So, you add interest. But when profit increases, will the government keep quiet? They say, please pay tax, please pay tax. So your profit increases by interest, and on that you pay tax. To that extent, your profit will. In simple words, how do we calculate income? To income after tax, we multiplied by 1 minus T. Profit before tax into 1 minus T is profit after tax. So interest, to that extent your profit will increase, then we multiplied by 1 minus T. Both way you get the same answer. But sometimes institute does not do this 1 minus T. Sometimes they do. That is alternative points of view. So when you do 1 minus T, you are not taking away the tax element. So you are not interpreting the debt is not there. You are just interpreting what is my profit before interest. But tax benefit I will take. But I want the profit before interest. Like the way you do in cash flow statement. What do you do in cash flow statement? Profit after tax, a profit as per P&L account, add interest, then minus interest. You do it in investing activities or financing activities, I'm sorry. So when you take cash flow into consideration, you add only interest, you don't do 1 minus T. So when you do cash flow from operating activities, cash flow impact, you add back interest, because it's a non operating expense, it's a financial cost. In financing activities you subtract, but we are considering operating profit. So there is a difference of opinion here. Some people believe plus interest into 1 minus T should be done, because that is purely considering that debt is not there. There you do into 1 minus T. Some people believe cash flow approach. If you follow cash flow approach, 1 minus T will not come. You can write that note somewhere. If cash flow approach is followed, if cash flow approach is followed, then 1 minus T does not apply. If cash flow approach is followed, 1 minus T does not apply. Which method you follow is left to you. I mostly follow this one only, what I gave you. But sometimes, suppose you see institute solutions, you should not get confused. So I've given this for your clarification. But majoritarily, we follow this formula only. PAT plus interest into 1 minus. Okay. Now, what is capital employed? Equity plus debt. Equity means share capital plus reserves and surplus. That is all your long-term debt, long-term loan will take into consideration debentures, bonds, etc. WSCC means it is a combination of cost of debt and cost of equity. Cost of equity, we do it using CAPM method. Cost of debt is the rate of interest into 1 minus T, because rate of interest would be before tax. We need after tax, so we multiply it by 1 minus T. So WSCC will be calculated by cost of debt into weight of debt plus cost of equity into weight of equity. And the cost and the weight elements, if they give you debt amount separately, equity amount separately, we can calculate. But suppose if they give you in the ratio format, debt equity ratio, you know how to do it. Debt by debt plus equity, equity by equity plus debt. Or if they give you debt ratio, you can use directly for weight of debt, equity ratio directly for weight of equity. Difference between debt ratio, debt equity ratio. I hope you are clear. We have already discussed it earlier. Okay, so I hope you are clear on this economic value added. Any doubts, my dear friends, in this regard? Any doubts? Will we go further on this? Can you please confirm? Will you go further? Any doubts? Yes. Okay. Thank you. Okay. Uh, Economic value added we have done. Two more things are there. One is called as market value added. And the other is shareholders value added. Very rarely asked, but still can be asked for 4 marks or something. Let's do it. It was more of a financial reporting in the old syllabus. Now they have pushed it to the new syllabus in the SFM. Market value added, MVA. This is the difference between market value of the firm, the entity, minus book value of the firm. So firm means what and all we take into consideration? Market value of equity plus market value of debt plus market value of debentures. If a bank loan and all is there, book value only will come. Market value of preference shares minus their book value, that is book value of equity. Book value of equity means what? We get equity share capital plus preference share capital plus reserves and surplus, because book value of equity means equity share capital will come, reserves and surplus will come, plus any book value of debt we have like debenture, bank loan, etc. Market value of the firm minus book value of the firm. Shareholders value added means, as the name suggests, shareholders value, and here we only talk about equity shareholders when we say shareholders. So it is market value of equity minus book value of equity. So market value of equity, how do we calculate? It's like market cap. They call it as market cap. Anyway, so market price per share into number of shares. Debt is included. Why debt is included is part of the book value of the firm. When I say firm, capital employed, it's part of the firm. Firm is debt plus equity, long term investors. Debt is included in books. Yes, debt value, book value, debentures, bank loan, book value is all part of the books. So market value of equity is market price per share into number of shares minus book value of equity, means we get equity share capital plus reserves and surplus. Anyway, just the difference between basically what you're showing in your books and what you're showing, what is the market value of it. The difference, the excess, is what is called as the shareholders value added. Okay, these are the basics. Let's take up some problems based on this. Just 1 second. Just give me 1 minute. System is taking some time. Just give me 1 minute. Okay.
Okay, hope you got this one. A problem on EVA, economic value added. Herbal's world is a small but profitable producer of beauty cosmetics using plant aloe vera. Some story and all they're giving. Though this is not a high-tech business, yet Herbal's earnings have averaged around 18.5 lakhs after tax, mainly on the strength of its patented beauty cream to remove the pimples. So it's not a technology business, high-tech business, but they have some patents because of which they could achieve 18.5 lakhs profit after tax. The patent has 9 years to run, and the Herbal has been offered 50 lakhs for the patent rights. Herbal's assets include 50 lakhs of the property, plant, equipment and 25 lakhs of working capital. However, patent is not shown in the books of Herbal world. Assuming Herbal's cost of capital is 14%, calculate economic value added. So much thing they have given. Only point of distinction in this problem is when you say capital employed, right? What is capital employed? If I do liability method, equity plus debt. If I do assets method, fixed assets plus current assets minus current liabilities. Both are same, no? Basics, balance sheet. We have share capital, reserves and surplus. Put together, we call it as equity. Then we have long-term debt, which we call it as debt normally. Then we have current liability. So equity plus debt is what we call it as capital employed. Or from the assets side, fixed assets plus current assets minus current liabilities. So fixed assets plus current assets minus current liabilities also will give me capital employed. Or what is current assets minus current liabilities? Working capital. So capital employed can be calculated as equity plus debt, one method, or capital employed can also be calculated as fixed assets plus current assets minus current liability, nothing but working capital. So asset method also you can calculate, liability method also you can calculate. In this problem, we have assets information. But one question is the patents, they are not showing in the books of accounts. You know, accounting reasons, accounting standards, stipulations. The patents are not shown in the books of accounts, but it has got some market value. That is, people are ready to pay 50 lakhs for the patent rights. Why it is not shown in the books? Let's not worry about it. Don't ask me accounting standard questions. They just told Herbal, however, patent is not shown in the books of. That's it. But patents are the driving factor to generate profits. The question is this: should it be part of capital employed? The answer is yes. Because when I say capital employed, we are not worried about what is shown in the books or not. What is actually employed in the business? And on that, how much return we are supposed to generate? If we generate more, that means there is value addition. So patents also should be part of capital employed. So let's take fixed assets. Let's take current asset, working capital, and let's take patents. Fixed assets, they said uh, property, plant, equipment, 50 lakhs. Okay, let's say PP, fixed assets, rupees lakhs. Working capital, uh, 25 lakhs. And the patents, 50 lakhs. So capital employed, 125. So what is economic value added? NOPAT minus capital employed into WACs. NOPAT is given 18.5 lakhs after tax. They have given profit after tax. No other information. It's NOPAT only. Capital employed 125 into 14%. So how much you get? The 18.5 minus 17.5. So 18.5 we are getting 17.5 is what we are expecting from the capital employed. So we are getting extra 1 lakh. That extra 1 lakh is what is called as economic value added, more than our expectation. So if it is negative, don't think it is a loss. It just means our expectation is not met. EVA positive means our expectation is exceeded. EVA negative means expectation is not met. Okay, hope you got it. I'll go further. You can come to the next problem. You can come to the next problem. ABC Limited has divisions ABC. This is the next one. Next problem, right? Okay. ABC Limited has division ABC. The division C has recently reported on annual operating profit of 20 crores 20 lakhs. Recently, annual operating profit. We also want operating profit only. This figure is arrived at after charging 3 crores, full cost of advertisement expenditure for launching a new product. The benefits of this expenditure is expected to be lasted for 3 years. Now, you know, again, as per accounting standards, you would have taken to P&L account. Accounting standards, because advertisement expenditure are not any intangible assets. But purely from benefit point of view, from the accounting point of not from the economics point of view, this has got a longer benefit. Cost of capital of the division C is 11% and cost of debt is 8%. Net assets of divisions of C as per balance sheet is 60 crores, but replacement cost of this asset is estimated to be 84 crores. A replacement cost means market value. You are required to compute EVA of division C. A very simple problem, small mistakes that people can do here. Okay, first point. Should I take 60 crores or 84 crores as capital employed? When I say capital employed, it's the value of money invested in the business. So we'll take market value, replacement cost. So 84 crores. Now, we are having some advertisement expenditure 3 crores, and the benefit of this is 3 crores will be for lasted for a period of 3 years, which means I know accounting wise you have taken full amount, but if you purely want to take economic value of it, how much is attributable to current year? 3 crores is about 3 years. That means current year should be only 1 crore. So from economic angle, 2 crore extra have been charged. So I will add back to get the net operating profit. Again, EVA is a judgmental value. We don't have any standards to calculate EVA. So applying the logic, we have to calculate. So 3 crores spread across 3 years. 1 crore supposed to be the amount, but 3 crores charged. So extra 2 crores I will add back. That will give me the profit for the year. And one more point. Cost of capital, they said 11%. So will I choose 11% to compute EVA? Or will I choose 8%? Or will I take an average of these two? What do you think I will do? Will I take 11%? Will I take 8%? Or will I take average of these two? What do we require? For EVA, we require WACC, weighted average cost of capital. Correct? WACC. So what should I do? Should I take 11? Should I take 8? Or should I do average of 11 and 8? Read the question carefully. This is cost of capital 11%. Cost of capital, they have not told cost of equity. They have not told cost of debt. They said cost of capital 11%. Cost of capital means WACC only. Overall cost of capital means weighted average cost of capital. So 11% given directly. But in examination mindset, what can happen? Cost of, you read this as cost of equity, because in the earlier problems we have done like that. Cost of equity, cost of debt, and we mix both and we calculate weighted average cost of capital. We have been used to that calculation. So in the same mindset, you go for examination hall. You don't read this. Cost of equity 11, cost of debt 8. Let's take a weighted average of that. I mean, first of all, weights is also given, not given. Some people take simple average and do it. But cost of capital itself means overall cost of capital. WACC. No need to do any further calculations. So let's calculate this. Easy one. So NOPAT is actually, even though they have given 20.2 crores, we'll add back 2 crores. That is 3 crores expense minus 1 crore. That should be correctly amortized. So extra 2 crores, we're adding it back. Rupees crores. 22.2 crores. Okay, minus capital employed into WACC. Capital employed, replacement cost we take 84 crores. WACC 11%, cost of capital given directly. So 84 into 11%, 9.24 crores. So difference is EVA. That's all, nothing else in the problem. 12.96. Okay, let's go further. I hope this is the question you have. Calculate the economic value added with the help of the following information of hypothetical limited, financial leverage, capital structure, reserves and surplus, debenture, cost of equity, income tax rate. Okay. So what and all we require? First of all, we require NOPAT, EBIT into 1 minus T. We don't have that information. What information available? We have financial leverage. Remember, what is the formula for financial leverage? EBIT divided by EBT. We don't have information on EBIT. We don't have information on EBT. Then how do we proceed? Can you think of something? Financial leverage formula, EBIT by EBT. That's why basics are important. But we don't have EBIT information in the problem. We don't have EBT information in the problem. What do we do then? EBT, how do we calculate? EBT is EBIT minus interest. Interest we can calculate 10%. debentures on 400 lakhs. So using the interest, I'll be able to calculate EBIT. How? Look at this how. Financial leverage is EBIT divided by EBT. And what is EBT will be calculated as? EBT is nothing but EBIT minus interest. EBIT minus interest. Financial leverage given 1.4. EBIT we don't know. For simplicity's sake, I'll take it as X. Every time EBIT repeating becomes confusing. So EBIT as X minus interest. Interest is 400 lakhs, 10%. That is 40 lakhs. So let's cross multiply. 1.4 into X, 1.4X, 1.4 into 40, 56. This X remains as it is. X, I'll bring it to left side. So 1.4X minus X equals minus 56 goes to right side, becomes plus 56. So 1.4 minus 1 means 0.4X is 56. So X is 56 divided by 0.4, 140. And what is X we have taken? EB8. EB80 is 140. Okay. You can also calculate in one more manner. That is cross multiplication method. But that is possible only when you are very confident in concepts. Let me explain. What is financial leverage of 1.4 would mean? If I take EB80 as 1.4, EBT is 1. Then can you tell me what is that 0.4 represents? Are you understanding? EBIT and we have EBT. The ratio 1.4 means if EBIT is 1.4 for 1 rupee EBT, what does the difference would represent? Obviously interest, which is in ratio terms 0.4. And how much is the interest amount? 40, right? So how much is EBIT? Cross multiply 40 lakhs into 1.4 divided by 0.4, 40 into 1.4 divided by 0.4, you get 140. Directly you have got. No need to do circus like this. Of course, it requires your conceptual clarity. What does that ratio means? And that's why I always say, don't just calculate the formula. Once you get the answer, try to interpret. Anyway, so let's calculate the formula EVA. No part we can calculate. Oh, we require cost of equity given. We need a couple of more things. Okay, I think I'll have to go to next slide maybe. No part means EBIT require, that is fine. Capital employed, debt plus equity we can do. I need cost of capital. So cost of equity given to be 17.5. Cost of debt not given. Rate of interest into 1 minus t. Rate of interest 10% into 1 minus t, 1 minus 0.3. So that will give you 7. Then what is the equity amount and what is the debt amount? Equity amount, capital plus reserves and surplus, 170 plus 130, which is 300, and debt amount is 400, I think. 400. So what is cost of capital? WSCC or overall cost of capital? Weighted average. So cost of equity 17.5 multiplied by its weight. which is 300 by equity plus debt. That is 300 plus 400. You can say capital employed 700 plus debt 7 into 400 by 300 plus 400. Debt value is 400. So capital employed 700. So what do you get? 17.5 into 3 by 7. 7 into 4 by 7. 11.5. Okay. So WSEC 11.5. Capital employed. Anyway, we know equity plus debt. That is 300 plus 400, 700. Just write down till here. Then I'll go to the next slide and calculate economic value added. Last line not visible. Not to write at the last. I'll try my best, but when I go further, I'll have to write, right? I just read capital employed 300 plus 400, 700. That's all what I've written. Okay, so I'll go to the EVA calculation. So EVA is NOPAT, or NOPAT I have not calculated, minus capital employed into WSEs. Okay, let me just calculate a NOPAT once. NOPAT is EBAT into minus EBAT we calculated 140 into 1 minus tax rate 0.3, 98. So EVA is NOPAT is 98, capital employed 700, WSEC 11.5%. So 98 minus 80.5. So minus 98, 17.5. This is also lakhs or crores something. Lakhs. Okay, lakhs. So this means more than our expected profit of 80.5, we got more. We got extra 17.5 lakhs. The extra profit, more than our expectation, is represented in EVA. Okay, hope it is done. I'll go further. ABC Limited's share are currently selling at 13 per share. There are 10,000 shares outstanding. The firm is planning to raise 20 lakhs to finance new project. First of all, I hope you got this question. Okay. Required. What are the ex-right price of the shares and value of the right if the firm offers one right for every 2 shares held? The firm offers one right for every 4 shares held. How does shareholders' wealth change from 1 to 2? How does right issue increase shareholders' wealth? Okay. We have to calculate X right price. First, we have to understand how many right shares are offered. The firm is planning to raise 20 lakhs. Uh, what is the right issue price? Oh, right issue price not given. Okay. They are having. Okay, they have to. Okay, fine, fine. Well, let's calculate. The firm offers rights one share for every 2 shares held. So, right ratio, can I say 1 is to 2? 1 is to 2. Correct? 1 is to 2. So, number of shares issued under rights, issued as rights will be 1 is to 2. 1 by 2 multiplied by 10 lakhs. 1 by 2 multiplied by 10 lakhs. So, you are going to issue 5 lakh shares. But what is the issue price? That they have not given. We have to calculate. So, what is the amount required? Issue price. Issue price will be amount required divided by number of shares. Number of shares. Amount required is 20 lakhs divided by number of shares is 5 lakh. I think 40 rupees per share. So issue price 40 rupees. Issue price 40 rupees. 40 or 4, sorry, 4 rupees, sorry, 4 rupees, right? Sorry, 4 rupees. 20 lakh by 5, 4 rupees. Issue price. X right price, you know the formula. So let me do directly. X right price. Directly I can go. I don't, or I should, do you want total number of shares? Okay, let me do total number of shares. 10 lakh shares multiplied by 13 rupees plus 5 lakh shares multiplied by issue price 4 rupees divided by total 10 lakh plus 5 lakh. Or you can do ratio also. Ratio is 1 is to 2. No, 2 is 2. If you have 2 shares, you get 1 share. That is also fine. So that is 130 plus 20 divided by 15. 10 rupees. X right price. They've asked only X right price, no value of the rate and all. Okay, well, X right price, that's all. This is ratio 1 is to 2. Second, if 1 is to 4, same method, same process, ratio 1:4. Number of shares issued as rights. 1/4 into 10 lakhs. 1/4 means 1 for every 4 share held. 2,50,000 shares. I think if you raise the less number of shares, I think it should be double. 8 rupees should be answer. Anyway, let's calculate. So issue price, amount required, same, 20 lakh, divided by 2,50,000, which is 8 per share. Logically so, you issue 1:2, you issue more number of shares, value per share will be less. If you issue less number of shares, you have to collect more money. See, you are raising 5 lakh shares, you are collecting 4 rupees. Now it is only 2,50,000 shares you are collecting with less number of shares, so value per share should be more. Then only same amount you can collect. Anyway, that is mathematical part, you leave it. Let's go for X right price. That is 10 lakh into 13, that will remain same. Existing number of shares into fair value before, right? Then issued 2.5 lakh shares multiplied by 8 rupees divided by 10 lakh plus 2.5 lakh shares. So 130 plus 20 divided by 12.5, 12 rupee per share. So earlier we got 10, now we got 12. Issue less number of shares, so value per share is more. Are you done till here? Please confirm. Shall I go further? Third part of the question. Okay. How does shareholders' wealth change from 1 to 2? And I mean, how does right issue increases shareholders' wealth? They have not asked under which scenario, whether the person subscribes or does not subscribe or sell the rights. We don't have to give all situations. We can give under one situation. Obviously, if he remains silent, he will lose for sure. So let's give it under one assumption. Impact on shareholders' wealth. Assuming he subscribes to the rights. Assuming he subscribes. Three scenarios possible. He subscribes, selling the rights, and remain silent. And that too, we have 2 ratio. So if it 3 scenario, 2 ratio, totally 6 scenario will be there. Too much. So when the marks does not justify, you don't have to write so much. You can say one scenario and solve that. Assuming he subscribes, and how many shares they have not given, for let's say 100 shares. Assuming he subscribes for present 100 shares. Present 100 shares. So I'll just do in a columnar format. Right issue 1:2. Right issue 1:4. Present holdings. He has 100 shares, my assumption. And issue price, I mean, before the share price is 13 rupees. So 1300. And here also 100 into 13, 1300. And he subscribes to rights. And how many rights he gets? 1/2. So 100 shares into 1/2 means 50 shares multiplied by right issue price. What is the right issue price? 4 per share. 200. And in right issue 1:4, 1/4, 100 into 1/4 into 1/4 means 25. And what is the issue price? I think 8 rupees, 200. So total he paid 1300 earlier. He paid 200, 1500. Okay. So holdings after the value of holdings after, right? Value of holdings after, right, is he will have how many shares? 100 shares he had already. He got 50 shares multiplied by ex-right price 10 rupees. So 1500. So impact 0. And here you had 100 shares. You got 25 shares. And it is 12 rupees. I think that is also 1500. 125 into 12. Yes. So impact 0. So when he subscribes or when he sells his rights, no impact. Anyway, we've not shown all the situation. One assumption is sufficient to describe. If time permits, you can also go for other scenarios. I think we have some time. So let me also show you other scenarios. From exam point of view, this one scenario is sufficient. He subscribes to rights. Or anyway, I think you can do it yourself. You know how to do it. One scenario is sufficient. Rest I leave it with you. Hope you are understood enough to try on your own. Okay. Hope you got about the right issue. Okay. So hope you got this question. Let us read into it. Eager Limited has a market capitalization of 1500 crores and the current market price of the share is rupees 1500. It made a profit after tax of 200 crores and the board is considering proposal to buy back 20% of the shares at a premium of 10% to the current market price. It plans to fund this through 16% of bank loan. You're required to calculate the post buyback earnings per share and the company's corporate tax rate is 30%. In some problems, they will ask you how many shares to be bought back to maintain certain conditions. But in this problem, the data is clearly given. Profit after tax is there. Number of shares we can calculate, and we just have to calculate post buyback what will be the market price per share. Post buyback what will be the earnings per share. Just read the problem once more. Okay. So let's do one thing. Let's have one column for before buyback. Then we'll have one column for after buyback. Okay. So we will write number of shares. How many shares were there before buyback? Specifically, they've not given, but we can calculate. Market capitalization of 1500 crores. And the current market price is rupees 1500. So you can know number of shares because market cap is what? Number of shares into market price per share only. So 1500 crores divided by 1500 means number of shares is 1 crores. That is the number of shares we had got before buyback. And they have bought back how much percentage? 20% of the shares. So 20% of 1 crore, that is 0.2 crores. And 0.2 crores, yes, 20 lakhs. So 1 crore minus 0.2 crores. So after buyback, I can tell number of shares is 0.8 crores. 80 lakhs, you can see. That is number of shares situation. Now, similarly, what else we require for us to compute EPS? EPS is profit after tax divided by number of shares. They've given profit after tax of 200 crores. But we have some adjustments. What adjustments? Will the profit change? Yes, sir, profit will change. What is the reason? Because you have taken a loan. To do the buyback, you have taken a loan for which you are going to pay interest. Now, when there is interest, you will have an impact on profit after tax. So, for that, we need to know the amount of loan taken. For that, we know, for which we need to know amount of buyback. So, what is the amount of buyback? That is equal to the amount of loan obtained. They have taken 20% of the buy shares, that is what is 0.2 crores, we know number of shares, and at a premium of 10%. So 1500 is the share price at a premium of 10%. So it is going to be 0.2 crore shares, number of shares into 1500 plus 10%. I think 1650, I believe. 1500 on 10% means 150. So 0.2 crores into 1650. 330 crores. Okay, this is the amount of buyback. But what is the impact? The impact is interest. So if I say, okay, interest, let me calculate, or let me just say profit after tax. What is profit after tax before buyback? It was 200 crores. Now, because of buyback, you will have a interest payment. So, how much is going to be the interest payment? On 330 crores multiplied by rate of interest 16%. But one thing I would like to tell, interest always comes before tax, right? So what we should do here, if you want to know the impact on profits, we should take after tax. So multiplied by 1 minus tax rate, 1 minus 0.3. This is going to be the interest expense after considering the impact of tax. So 330 into 0.16 into 0.7, 36.96. 36.96. Of course, crores. So if you subtract from 200, you get 163.04. There is one more way also you can ascertain. What you can do, profit after tax is there. We have tax rate. Make it as profit before tax. How do you make it profit before tax? You divide this number by 1 minus t. To make it into after tax, we multiplied by 1 minus t. To make it into before tax, we will divide by 1 minus t. Then you subtract interest. Then again you multiplied by after tax, that is you multiplied by 1 minus t, or you subtract tax 30% on that, effectively you'll get the same profit after tax. So from profit after tax, make it to before tax, adjust interest expense, then come back to profit after tax. You'll get the same exact number. You can try it out. Okay, what is EPS is what they asked. They asked only after buyback. Let me calculate before buyback also, just for reference. So we have a profit of 200 crores, number of shares as 1 crores. So 200 crores divided by 1 crore, which is 200 per share. And after buyback, profit after tax of 163.04, number of shares of 0.8 crores. So 163.04 by 0.8. 203.8. 203.8. Okay. Sometimes they can ask one more question. They can also ask estimate market price per share after buyback. So what will be the process then? We follow based on P ratio approach. So before buyback, what is the P ratio? Before buyback, the P ratio is MPS by EPS. That is market price per share is 1500 and EPS is 200. So 1500 by 200, which is 7.5. And assuming the P ratio remaining same, if you assume ratio remaining same, assume P remaining same, same ratio if I apply, I know the EPS 203.8. So what will be the market price per share? 203.8 multiplied by 7.5. 1528.5. So basically, when buyback happened, earnings per share increased. This is one of the reasons why, even in practical life, whenever there is an announcement buyback, it's a good time to buy the shares, of course, only for short term periods. Anyway, so this part, they're not asking the problem, but I'm just telling you, in case in some problem, if they ask, we have to follow the process like this. Okay, so please write it down and let me know if you have any doubts. Okay, so I believe it is done. I'll go further. Hope you got this question, an exam question. Intel Limited, promoted by transnational company, is listed on stock exchange. The value of the floating stock is 45 crores. The market price per share is 150. Capitalization rate 20%. Capitalization rate means cost of capital. The promoter holding is to be restricted to 75% as per the norms of listing requirement. The board of directors have decided to fall in line to restrict the promoters holding to 75% by issuing bonus shares to minority shareholders while maintaining the same PE ratio. You require to calculate bonus shares, market price per share after issue of bonus shares, free float market capitalization after the issue of bonus shares. So, what is the requirement of this status or this law? Let me tell you quickly. The promoter's holding should not be more than 25% in a listed company. That means at least 25%, should be held by public. That what is held by public is called as, you can say, floating stock, or you can say the free float, because what is held by promoter is not traded. What is held by non-promoters, held by public, that is only available for everyday trading purpose. Therefore, the SEBI requirements is promoters holding should be restricted to 75%. But what is the current holding? Uh, the value of floating stock is 45 crores. The market price per share is 150 crores. Not specified. Is the existing thing. Have they specified? Uh, Value of the floating stock is 45 crores. Market price per share 150 crores. Okay. No, the question, I think question is not specified, I think, right? I think question they have not specified. Where is it given in 80%? Okay, okay. I think in this question, I think I've not included. Okay. Okay, fine. I think here in this question I have not specified. Uh, okay, fine. Okay, I think here it is not added. So you please add it. I think in this question it is missed out. It is no, no. So it is missed in the question. So you have to add it. So actually it's missed in the exam question also. But because without existing percentage we cannot solve the problem. We should know existing percentage to reduce it to certain percentage. So let's do one thing for the question. Let's make that change. Promote tax company. Let's just say holding 80%. So you can just add this number holding 80%. Because even in the I think exam solution they have assumed something. You can assume 90% also in the exam if they're not specified. But without assuming something, we cannot solve the problem. And that, in my opinion, is a clear miss of information in the problem. That is a mistake, I would say. But that's what happens in exam. You can't say that it's a mistake in a problem, so it cannot be solved. You will not get any grace marks in exam. No grace in CA exams. So if there is a mistake in the problem, if there is a conflicting information in the problem, if there is a missing information in the problem, you have to make a appropriate assumption and you have to solve it. I'm sure the initial sentences would have made it very clear in the question paper. They would have told you, you are required to make appropriate assumptions wherever necessary. But you can't write that in your answer paper. While writing answer paper, at the end you write, while valuing my paper, make appropriate assumptions wherever necessary. I mean, they can do, but you can't do it. That is an unfair system, but can't help. So we'll make this assumption for our convenience. We have made the change in the question itself so that everybody can follow the same answer. In the exam, if there is a missing information like this, you can have a alternate assumption. It is definitely valid. Okay. So existing holding 80%, you would like to restrict to 75%. There is one way of doing it, which is what normally people do. You have 80%, you want to reduce it to 75%. Okay, 5% of the share you sell it to public. You sell it to 5%, 80% becomes 75%. But there is one more way, which is very intelligent way, creative way applied in this problem. But of course, that's not very popular in practical life, but very popular in exams. So what do? You issue bonus shares, not to yourself, only for public. So you see, currently you have 80, 20. Let's say 80 shares, 20 shares. Now you start giving bonus shares, 20. Let's say you give 20 more shares. Don't give yourself anything. So what will happen to the total shares now? You will have 80, they will have 40. So if you compute the percentage, 80 divided by 120, right? 80 plus 40, that is almost comes to 75%, I think. 8 or 66, 80 by 120. 66 percentage. See, you are able to reduce the holding without increasing or selling your shares, just by issuing bonus shares only for the public. That's what they are trying to do. So we have to issue certain number of bonus shares only to public, such a way that their uh, holding will become 25%, promoters holding will become 75%. That is what we are trying to approach here. Okay, so this also, let me do it in a columnar format. Okay, so this I'll say uh, before bonus, then bonus issue after bonus. Okay, what and all I require? First of all, I require number of shares. Do we have number of share information directly? We don't have. We have the value of floating stock 45 crores. So let's write it as this floating stock, or we'll say free float. Free float market cap, they have given as 45 crores. And market price per share, so divide by market price per share 150, you will get free float number of shares. 45 crores by 150. 0.3 crores, or I'll say 30 lakhs. And what about holding? Free float percentage and promoters holding percentage. Since promoters holding is given as 80%, we have assumed 80%, free float becomes 1 minus 80%, that is 20%. Total, 100%. And therefore, you'll be able to compute the promoters number of shares, promoters holding number of shares. Because this 30 lakhs represents 20%. How much for 80%? So 30 represents 20. How much for 80? So 30 by 20 into 80, which is 120 lakhs. And therefore, total number of shares, you can also say 30 lakhs plus 20 lakhs, 30 lakhs plus 120 lakhs. Total number of shares, 150 lakhs. Okay. Now, what is the requirement? Even after the bonus, our bonus should not be given to promoters holding. Promoters holding number of shares should be 0. No bonus should be given. So after bonus also, they will have same number of shares, which is 120 lakhs. And this should represent what percentage? This should represent 75%. So can we calculate how much should be the total, or we can also calculate how much should be the free float number of shares. In the sense, 120 lakhs represents 75%. How much for 25%? So 120 lakh represents 75%. How much for 25%? Which is 40 lakhs. So how much they were having earlier? Free float, public, 30 lakhs. And now they have to get 40 lakhs, means they should be given bonus of 10 lakhs. And therefore, total bonus will become 10 lakhs. And total number of shares will become 160 lakhs. And you can also calculate 40 by 160, that is 25%. 75 by, 120 by 160 is 75%. So what they're asking is the bonus ratio, first part of the question. So bonus ratio, you should give 10 lakhs for 30 lakhs, 10 lakh for 30 lakh. So ratio is 1 is to 3, 1 for every 3 shares held, only for public, only for free float, non-promoters. Okay, so this first part of the question. Second part of the question is, what is market price after issue of bonus shares? Market price after issue of bonus shares, if you remember in the earlier thing, how do you calculate before some event or before right or before buyback, after buyback, before bonus, after bonus? We will assume one ratio remaining same. What is that ratio? That is PE ratio. That's our basic assumption. If nothing else is available in the problem, of course. Market price after bonus issue means we would like to assume whatever is the P ratio before bonus is same even after bonus. Okay, so we will assume the earnings per share. We have market price per share. Capitalization rate is given. And one more thing, I don't know whether you remember, we have discussed in some different problem maybe. When nothing is specified in the problem, if you want earnings and no information is available, or even in the problem they said, while maintaining the same P ratio. They only have given the question as well. When nothing is specified in the problem regarding earnings, we don't have any other information, the capitalization rate will take it as reciprocal of P ratio. 1 by P ratio is capitalization rate, or 1 by capitalization rate is taken as P ratio. So let's make use of that. Okay, so let me continue the column. Before bonus and on bonus issue after bonus. So what we have is market price per share. Before bonus, it is 150 rupees. We need to know EPS for us to find out the ratio. So for that, we'll find out as using a P ratio, PE ratio. That is, I'll take it as 1 by KE. That is 1 divided by capitalization rate 20%, 0.2. That is 5 times. P ratio 5. So EPS will be MPS divided by P ratio 150 divided by 5, that is equal to 30. So what is earnings now, or profit after tax, let's say. EPS is 30 rupees multiplied by number of shares. How many shares we had? We had 150 lakh shares. So 30 into 150, 4,500 lakh shares. Now this 4,500 lakh share profit after tax does not change. You're not taking any loan. There is no expense being different. So 4,500 or 45 crores, that PAT will remain same even after bonus. This remains same. 4,500 lakhs. What will happen to number of shares? Number of shares, there is a change. We have calculated number of shares 160 lakhs. So what will be the EPS? 4,500 lakhs is the profit after tax divided by number of shares 160 lakhs. 28.125. 28.125. Then P ratio is same, which is 5, assuming P ratio same. So market price after bonus issue, market price per share, that is EPS 28.125 multiplied by P ratio into 5, 140.625, or you can say 140.62. So basically you are following this route. You're doing everything for bonus issue, then you are going after bonus, and then you are going up to the top. This is the route which you are calculating. So this one assumption you should know. When nothing else information available, we don't have profit after tax, they have not given EPS. So this is the only assumption valid from exam point of view. Okay, I hope it is done. Okay, let's go further. Okay, so the next question, no need to search. Sandy Limited has a book value per share of 140. Its return on equity is 16% and follows a policy of retaining 60% of its annual earning. What is the price of the share now if the opportunity cost of capital is 18%? Okay. Uh, what is this perpetual growth model? Gordon growth model. Okay, some people also call this perpetual growth. Why it is called as perpetual growth? Because constant growth we assume forever. That's why it is also called as perpetual growth. Constant growth model, perpetual growth model, dividend discount model, Gordon model, all are same. What is the formula? If you remember, P0 is given by, if you have D0, then we do D0 into 1 plus G divided by KE minus G. If that is not available, or if D1, dividend expected, is directly available, then we'll do D1 by KE minus G. Depending on, we have the last dividend or we have the expected dividend. D0 means last dividend. When you do 1 plus G, you get the dividend expected. If they give you directly dividend expected, that is D1, you can make use of it directly. K, cost of equity, opportunity cost, cost of capital given, growth rate not given, dividend not given. So how do you calculate dividend per share then? Dividend per share will be calculated by earnings per share multiplied by payout ratio. Payout ratio. We know payout ratio, but EPS not given. Okay, how do you calculate EPS? EPS is calculated by total earnings available to equity shareholders divided by number of shares. But that is not available. Earnings available to shareholder is not available. Then what is the ratio available? Let's see, we can think around that point. Simple approach. Keep this in mind. First, check what you want. Understanding? This approach, you can do it in this problem anywhere in your life also. First, search what you want. Is it there? What do you want? If not available, then what is available? Two simple things you have to check for it. Okay. Book what is available or what is required. Profit, earnings available to shareholder. Okay. Earnings available to shareholder, not available. Then what is available? Book value per share is available. Return on equity, ROE is available. Oh, then try to recollect. What is ROE formula? ROE is given by numerator profit, nothing but earnings available to equity shareholders divided by net worth, right? Divided by net worth. That is the share capital plus reserves and surplus, of course, into 100. So what we need here now, earnings available to shareholders. So how can I make use of this formula? Net worth multiplied by ROE. A net worth, here they have given book value per share. So per share only we want. So we can calculate EPS as book value per share, nothing but net worth per share, nothing but net worth you can say. Share capital plus reserves and surplus multiplied by ROE, return on equity generated by a company, that is 140 into 16%. 22.4. Then what is dividend per share? 22.4 is the EPS that just we got it. Payout ratio, retaining ratio. Oh, retaining ratio 60%. So what is the symbol we write for retention ratio? We write it as B, right? B for retention ratio we write. So I will do 1 minus B, 1 minus retention ratio, 1 minus 60%, because 60% if I retain, it implies 40% I am paying out. So 1 minus 0.6. So that is 8.96. So D1. Okay. Now here is one important question. Okay, one more thing we require. Growth rate also not given. Growth rate is B into R. B is retention ratio. We know 0.6. What is return on assets? That is return on investment generated by the company. How much return the company is generating? That is ROE only. How much company is generating? That is 16%. 0.16. Actually, it may not be exactly this, but we don't have any other alternative. So whatever company is generating from its assets, that is, we take ROE only. So 0.16 means we get 0.096. Okay, now one question comes. This dividend per share, 8.96, should I take it as D0 or should I take it as D1? It is D0 if you interpret dividend just paid. It is D1 if you interpret dividend expected to be paid. The question does not specify. When the question does not specify, you can interpret either ways. But institute mostly take it as D1. Institute mostly take it. Does not mean you have to take it because question is not very clear. So you can interpret either ways. Give a note in the exam. So this we are assuming as D1. This is assumed as D1. One of the assumption possible. You can also assume otherwise. because question is silent. But whichever way you assume, write a note in the exam. So D1 is 8.96 divided by K minus G, cost of capital 0.18 minus growth rate 0.096. 0.18, 0.096, 0.084. 8.96 by 0.084, 106.67. Okay, done. Okay, I'll go further. This problem, hope you got it, herbal box. This is a very similar problem that you would have seen earlier, but still I would like to solve it quickly. Exam question. Don't want to spend much time. I would like to solve quickly. Herbal box is a small but profitable producer of beauty cosmetics using the plant aloe vera. Though it's not a high-tech business, yet Herbal's earnings have averaged around 18.5 lakhs after tax, mainly through strength of the patents on beauty cream to remove pimples. The patent has 9 years to run. Herbal Box has been offered 50 lakhs for the patent rights. Herbal's asset include 50 lakhs property and equipment, 25 lakhs of working capital. However, the patent is not shown in the books of Herbal Box. Assuming Herbal's cost of capital is 14%, calculate economic value added. Let me solve quickly. This is a very small one, very similar one as well to the earlier ones. This has been asked in exam few times, EVA, so I'd like to do it quickly. So EVA is what is difference between your expectation and your actual number. So we say no PAT, that is your actual profit, net operating profit after tax, minus expected profit, that is what is capital employed multiplied by WACC. That is what is your cost expectation. No PAT, for that there's given average profit, uh, averaged around 18.5 lakhs minus capital employed, that is not only shown in the books, even market value, which is not shown in the books, which includes patent value. So 50 lakhs of property and equipment, 25 lakhs of working capital, plus 50 lakhs of patents multiplied by 14% cost of capital, that is 18.5 minus, this is 125 into 14%, 17.5. I think you get 1 lakhs as economic value added. Yes, it hardly took 2 minutes, but I just wanted to cover this before I go further. I'm just looking for one problem. We'll just do it. Okay, I'm not able to find it. One last try I'll do. Okay, let's go further. Okay, so hope you got this question. This is an July 2021 question, which for many students turned out to be a disaster because most of the questions in this question paper were reverse working problem, old syllabus. New syllabus people were happy, but old syllabus for people were very, very unsatisfied. I released a video also saying this was not a difficult paper, it was a tricky paper. Just the reverse working is what they asked, and I got very, very abusive comments as well. Anyway, so let's try to solve this one. I'll tell you how it's a straightforward problem asked in a slightly different manner. Hope you got this question. July 2021 old syllabus question. NM Limited is aspiring to enter into capital market in 3 years time. The board wants to attain a target price of 70 for the shares at the end of 3 years. The present value of the share is 52.03. Dividend is expected to grow at the rate of 15% for the next 3 years. NML uses the dividend growth model for the projections. Required rate of return 15%. You are required to calculate the amount of dividend to be declared by the board in the base year so as to achieve the target price. So usually what we used to do, they used to give the dividend, they used to give the uh, growth, and we used to calculate the present value. And in this problem, they have given the present value and we have to calculate the dividend. Let me explain once more. So what we used to do, the dividend will grow at the rate of 15% for the next 3 years. And after that, there is no growth. So you know what we used to do? Year 0 today. Then year 1, year 2, year 3, year 4 onwards. Remember what we used to do? And here we will calculate D1. Here we will calculate D2. Here we calculate D3. And D4 onwards. Can you remember what we used to calculate? D4 onwards. We will use to convert this into a terminal value or a price. What is that called as? Or which year that number will be? D4 onwards. Using D4, we get TV3, right? One term less. That is D4 onwards means we used to get this as, D4 onwards means this we will use to discount and this we will get it as TV3, one term less. Then what we do, this TV3 will bring it to the today value, D1 will bring it, D2 will bring it, D3 also will bring it, and together we call this as P0. This was our process. Now observe what is given in the problem. Wants to attain target price of 70 after 3 years, at the end of 3 years. So this TV3 or P3 given as 70 rupees. We don't have to calculate. That 70 rupees they have given. The present value of the share is 52.03. P0, this is also given 52.03. And growth rate, it is growing at 15%. So growing at 15% annum for every year. So how do we use to calculate dividend? We say D0 into 1 plus G. That dividend is what I have to calculate now. So if I write in tabular format, how does it look like? Year, cash flow, discounting factor, discounted cash flow. So here we will write year 1, year 2, year 3, year 4 onwards. And for year 1, I'm going to use D1. For year 2, we will do D2. For year 3, we will do D3. Year 4 onwards, TV3 or P3. Now year 1, how much is cash flow? I don't know. So that is D0 into 1.15, 1 plus 0.15. D2 is D1 into this, or directly can I say D0 into 1.15 square, and D3 is D0 into 1.15 cube, and P3 is given as 70. Discounting factors 0.8696, 0.7561, 0.6575, and this also will be same thing, 0.6575, and this present value they have given as 52.03. We just have to simplify that. So this, if I multiply 1.15 into 0.8696, 1 only you get, I think, that is D0 only you get, D0 into 1, 0.7561 into 1.15 square. This also 1 only, so this also you get D0, 1.15 into 0.6575 into 1.15 into 1.15. This also you get D0 only, 1 only. Why it is happening? Why is that situation? Because your required rate of return is 15%, growth is 15%, compounding by 15, discounting by 15, ultimately nullified. Anyway, mathematically, you will get that number. And 17 to 0.6575, 46.025. So you add all D0, 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 that is 3 times D0 plus 46.025, that is equal to 52.03. Take it to right side, 3D0 is 52.03 minus 46.025, or you can say 03, you can round off this actually. Anyway, 52.03 minus 46.025, 6.005, you can just say 6 rupees. So 3D0, D0, 6 rupee by 3 rupees. So D0 is 2 rupees. So the company should declare in the base year just dividend, that is 2 rupees. So it's not a different question. I have seen many exam question papers where it was given out of syllabus, in the sense many difficult questions are asked where the formula was not in regular classes and those formulas were directly asked in exams. That was difficult. The students could not have been expected, but this is regular problem. Instead of asking you the present value, they have asked the dividend. Anyway, so people are frustrated, so I have to receive the, I was on the recipient end. Anyway, Okay, so hope this is fine. I'll go further. Okay, still writing, no problem. Okay, next. Again from the same examination, July 2021 question, SM Limited has a market capitalization of 3000 crores, current earnings per share of 200 crore with a price earning ratio of 15. The board of directors is considering a proposal to buy back 20% of the share at a premium, which can be supported by financials of the company. The board expects post buyback market price per share of 3057. The post buyback PER means price earning ratio will remain same. The company proposes whom to fund the buyback by availing 8% bank loan since available resources are committed for expansion plans. Assume tax rate 30%. You're required to calculate interest amount which can be paid for availing bank loan, the loan amount to be raised, premium per share, and the percentage of premium paid over current EPS. Again, a reverse problem. Normally, in what used to happen in buyback problems, they used to give number of shares, they used to give the buyback price as well, and we used to calculate after buyback what is EPS, assuming P ratio same, after buyback what is market price per share. We used to calculate in a normal manner. But in this problem, it's reverse calculation. They have given the market price per share after buyback directly. So we have to calculate little bit reverse working. So if you're thorough with the concepts, the formats, the columnar format which I usually recommend, this will not be much complicated one. But anyway, read the problem once more, then we'll do it in a columnar manner. Okay, so let's do it in a columnar format. What column we used to follow? We simply say before buyback, buyback, and after buyback. What information we have? Market capitalization of 3000 crores and current earnings per share is 200. Current P ratio is 15. So EPS 200. PE ratio 15. When we know EPS and P ratio, what we can calculate? We can calculate market price per share. So EPS into P ratio, that is 200 into 15, EPS into P ratio 3000, is it? Before buyback, market price per share is 3000. Now, after buyback, P ratio that's remaining same. So it will be 15 only. Market price per share, they only have given. Post buyback, market price per share 3057. So what is the best part? I can even calculate EPS, that is MPS by P ratio. So 3057 divided by 15, 203.8. Okay, we just look at number of shares if any information is available, or number of shares no information available. We have market capitalization. When we know market capitalization, I can compute number of shares. Market cap 3000 crores. So number of shares 3000 crores divided by 3000, that is 1 crore shares. Okay, now how many shares that is bought back? They specifically told 20% of the shares are bought back. So 20%, 1 crore into 20% means 0.2 crores or 20 lakhs. So what will be the number of shares after buyback? 1 crore minus 0.2 crores, which is 0.8 crores. Okay. Now can you think? We know EPS, we know number of shares. When I know EPS and I know number of shares, what we can calculate? If I multiply EPS with number of shares, I'll get profit after tax. Nothing but earnings, right? I'll get profit after tax. That is EPS multiplied by number of shares, 200 EPS multiplied by 1 crore, which is 200 crore. And here also 203.8 multiplied by 0.8 crores, 163.04. Now, what is the difference? Why there is a difference between the two profit after tax? That is purely because of interest, but interest after tax. But anyway, so what is this interest differential? 200 crore into 163.04. 200 minus 163.04, 36.96. But remember one thing, this is interest after tax. You remember, you would have discussed in the earlier problems, it is interest. We don't directly subtract interest. What do we do? Interest, I multiply it by 1 minus t, right? To make it into after tax. Interest into 1 minus t. That is what is this difference. Or you can follow one more method. Profit after tax before buyback, convert this into before tax, dividing by 1 minus t. We have after buyback profit after tax, converted into before tax, dividing by 1 minus t. Now both are before tax. The difference you find out, that is interest. Both way you can do. So interest amount before tax is 36.96 divided by 1 minus t. Tax rate 30%. 1 minus 0.3, that is 0.7. So interest is 52.8. What and all they've asked? Interest amount can be paid for availing the loan. That is 52.8. First part of the question. Interest amount 52.8 crores. Second part of the question. Loan amount to be raised. Okay, now the question comes, how much is the loan amount? We have got the interest amount, but how much is the loan amount? For that, you know what is the rate of interest? They said company proposes to buy back by availing 8% bank loan. You can compute the loan amount, 52.8, 8%. So how much is total? So you can divide by that percentage. Loan amount equals 52.8 crores divided by rate of interest divided by 8%, 660 crores. So you have raised 660 crores. On that, you are paying interest at 8%, means 52.8 crores. Third part of the question. What is the premium per share and percentage premium paid over current APS? Okay. This loan, 660 crores, is used towards buyback of how many shares? You see, number of shares, we had 1 crore and 0.2 crore is what we have bought back. And how much we have paid? 660 crores. So what is the buyback price? Buyback price 660 crores is the amount paid for 0.2 crores. So what will be the per share basis? 660 by 0.2, 3,300. And what is the current price? Current price is 3,000. But how much you paid buyback? 3,300. So what is the premium? 3,300 minus 3,300. 3,300 minus 3,000 is 300. So what is the premium percentage? Same, 300, but out of 3,000, that is, you can say 0.1 or 10%. You see, it's nothing complicated as such if we just solve it in a systematic manner. Just have to go with the flow. What we have, what format we follow, what we want to achieve. The same thing applies any problem in front of you, my dear friends. That's one of the biggest philosophical thought maybe when I see the mathematics books. Because many people say maths is full of problems. So we don't like it. But if you see it in another way, yes, it is full of problems, but every problem has got a solution as well. It's just that we don't know the solution. We have to learn to arrive at the solution. And what process we can adopt to arrive the solution, whether in exams or for any subject or for that matter, any problem in life. What is the problem on hand? What data we have and what I can do to achieve it. In this problem, our data or requirement was to find out the interest amount. So what format? Format we followed same thing. Before buyback, buyback, after buyback. So whatever data we knew, we start filling in. EPS, number of shares, MPS, P ratio. See, once you start filling it, you easily get one after the other like a solving a puzzle. This is like if you want to travel from, let's say, Bangalore to Chennai, you will not see the road here itself. Standing here, you can't see all the roads. But as you move further, you start seeing the roads, right? You can see the, let's say you're traveling in night. Your car, will it give the light vision till the Chennai? No, till the destination. As you move further, you start finding the next step. That is what you have to apply even in exams or in any problems. Okay, I've told you so much. I know extra GAN in the morning session may not work out. But the summary point I'm trying to tell you is this. When you see the problem in exams, First, start where you can. Start where you can. Simple 4 words. You don't know what to do, it's fine. It's not able to understand the problem, it's fine. Just read, see what you can do. When you don't know what to do what you can. In this problem, I don't know where to start. No problem. What information available? Market cap. Write down market cap. Then what information available? EPS P ratio. So before even forget about the targets, we have EPS, we have P ratio. I can compute market price. I have market price. I have market cap. I can compute number of shares. You understand my point? When you make a beginning, in my opinion, 50% of the problem is solved there itself. Everything is in the minds. So any complicated question you see, SFM, FR, costing, indirect tax, data tax, anything, first read the problem calmly and try to say what I can do here. Because the moment you're thinking of the repercussions, so what will happen, the results, what will relatives will tell, oh, next attempt also have to write. Rather than thinking all those things, just stick to the problem and say what I can do. That's what I would say. Rather than problem focused approach, you can have a solution focused approach. What we can do. Same thing, I mean, I may be extending, but still, my request, if you see any problem anywhere, on the road some problem, traffic jam some problem, anywhere, don't keep on blaming. Rather, try to think what I can do here. Okay, there is a traffic jam. Can you do something? Can you go and control traffic? Is it possible? If possible, please do it. If somebody is blocking the road, you just park the vehicle, go there, take 5 minutes initiative and do it. If you cannot do it, it's rain everywhere, blocked everywhere, just hold it. You can't do anything. Just pause yourself. So rather than think one problem, think something else. Okay, what I can do if I reach 2 hours late? What I can do there? What will happen there? Who and all would have come? If because of this delay, what will be the impact? How can I solve the impact? When can I work extra to cover that? You're thinking, right? I'm not telling think positively, think always optimistically. No, I don't say be optimistic. I don't say be pessimistic. I'll just say be realistic. Solution oriented approach. So when you see a problem in exam, if you don't know the concept what to do, when you see a problem in life, you don't know what to do one simple thing, think what I can do. If you start solving the problem, 50% of the solution lies there. Once you make one step, things will start unraveling automatically in most of the cases. Anyway, so too much of extra again may not work in the morning session. So please write down. If you have any doubts, let me know. Else, we'll move further. Okay, I'll go further. Hope you're done.